Yes, sir. Very happy morning to all. My dear lovable students, I know that our September examination is on the doorsteps. We are having very few days in that. I believe that you are preparing on a reverse order, that is FM and SM. If you are preparing FM and SM now, don't skip the case scenario material of both the FM and SM, my dear lovable students. Sir, with regard to case scenarios, in FM, we are having 35 questions to be solved. Sir, ensure that at least you would have tried 10 to 15 case scenario, minimum 10 to 15 case scenario. Sir, for helping you, we have solved the first 7 case scenario that will really give you a beautiful idea to proceed to the remaining case scenario. According to me, this is the best tool to revise the entire subject. This 15 mark will make you revise the remaining 35 mark. So you start enjoying case scenario number 1, 2, 3, 4, 5, 6 and 7. If more people are required, we are ready to serve more case scenario. Also, inform me that in the comments. All the very best, man. Don't say that in the September. Sir, in the September, mattunda will start with case scenario number 1. Sir, very happy afternoon to all. So we are going to start the discussion of the case scenario in the subject financial management. My dear lovable students, as we all know that we are having 3 papers in group 2. One is, sir, costing, other is audit and FMSM. As per the new trend of ICAI, every subject 30 mark they are testing as case scenario. That means in our subject FM, 15 mark will be tested as case scenario questions and remaining 35 mark will be tested as the descriptive. Before we start doing the case scenario, I will tell you, if you are preparing for the 35 mark, you can't write the 15 mark. But if you are preparing for the 15 mark, you can write the 35 mark. The reverse is possible. Sir, I studied all the chapter. Can I attend the case scenario? No, sir. Because if you want to write case scenario, you have to practice case scenario. Then only in examination, within that point of time, you'll be able to appreciate or understand. Come on. First case scenario. Always how to approach a case scenario in an exam. My dear lovable students, a big irrelevant story will be given in the question. Sir, 30% of the information given will be irrelevant. Only 70% will be relevant. So always the quickest way to answer a case scenario, don't read the case scenario. Read the question. What is the average level of receivable of the company? Average level of receivable of the company. That is what question number 1. How much advance factor will pay against receivable? So factor is a person. How much that person will pay to the company is the next question. What is the annual cost of factoring to the company is the question. What is the net cost to the company on taking factoring services is the question. What is the effective cost of factoring on advance received is the question. That means this case scenario is fully 100% has been asked from the working capital management. In that working capital management, there is a topic called as debtors management. In that debtors management, there is a concept called as factoring. You may be prepared factoring, you may not be prepared factoring. If you don't prepare factoring also, take this question as an opportunity to learn what is factoring because it's a very easy concept. I will explain the concept and I will tell you how to solve this case scenario. NV Industries Limited is a manufacturing industry which manages its accounts receivable internally by sales and credit department. It supplies small article to different industries. I told all these are irrelevant data. The total sales ledger of the company stands at 200 lakhs. That means the total sales for the year. Sales is equal to how much lakhs, man? 200 lakhs. Sales is equal to 200 lakhs. Of which 80% is of credit sales. My dear lovable students, out of this 200 lakh, we are having 80% and 20%. 80% is credit sales, and 20% is cash sales. Are you all really with me? Cash sales means if I make sales now, I will get the cash now. For that, debtors management concept will not be applicable. Since debtors management concept is not applicable, sir, factoring concept will not be applicable. So 200 lakhs into 80% comes to 160 lakhs is the annual credit sales. Company has a credit policy of 2 by 40 net 120. In the sense means, if you are giving me cash within 40 days, you are entitled to get a discount of 2%. If you have to pay within maximum 120 days. Past experience of the company has been that average out of the total, 50% of the customer avail of the discount and balance of the receivable are collected on average in how many days? 120 days. So indirectly they are talking about the debtors collection period. Are you all really with me? Debtors collection period, sir, 40 days into 50% comes to 20 days. And the second category is 120 days category. So 120 into 50% comes to 60 days. So 60 plus 20 comes to 80 days is the average collection period. That is the information they have passed on to us. Finance controller estimated bad debt losses are around 1% of the credit sales. So bad debts is equal to 1% of the credit sales, not the total sales, because total sale include cash sale. For cash sale, concept of credit sale will not be applicable. While escalating clause associated with the in-house management of the debtors, coupled with the need to unburden the management with a task so as to focus on sales promotion, CFO is examining the possibility of outsourcing its factoring service for managing its receivable. What they're trying to say is, are we making credit sale? Once we make credit sales, we have to get money should be collected from the debtors. It's really a tedious job in a sense means I have to call the debtors, I have to ask the debtors, when are you giving money? Why you have not given money yesterday? Sir, how much days you are saying tomorrow? That is a real headache. So what company is feeling that why we have to take that much pressure? Let we surrender this job to a person called as factor. Let him go and collect with that guy. I will pay him commission. I will pay him remuneration for the service what he is rendered to me. Are you really with me? Currently, the firm spend 2,40,000 per annum to administer its credit sales. Yes, I should appoint a person to call the debtors and say that when are you giving me money? Please give the money. They will give us check. That check has to be deposited on time. Sometimes it will bounce. I have to inform to the debtor that the check what you have given has been bounced. Please give me the another check. Like that, recovery process will be there. For that, currently, now the firm is spending 2,40,000 rupees. In the sense means, my dear lovable students, if I am going to factoring, this cost is avoidable. Right, sir? These are avoidable as a factoring firm is prepared to buy the firm's what? Receivable. What I will do is, my dear lovable students, I will sell my receivable to a factoring firm. They will give the money and they will collect from them. They will be acting as Raja, Vasul Raja, MBBS. They will go, they will collect. If they don't give the money, they will do the Kata Panchayat. Are you all really with me? Yes, sir. The main elements of the proposal are, one of the factories coming and saying that, why are you taking unnecessary risk, sir? We will take care. It will charge how much % commission? Just give us 2% commission for the service what we are going to render. It will pay advance against receivable to the firm at an interest rate of 18% after withholding 10% as a reserve. Wow. Sir, if you are ready for the factoring arrangement, you have to get money from the debtors. That money today we will give you to you as advance. It's like getting a bank loan. Sir, today you will get the money and later on a future date, we will collect from the debtors. Also, company has option to take long-term loan at 15% interest or may take bank finance for a working capital at how much percent interest? 14% interest. So I am having alternative option. If I am not going for factor, I will not get the money upfront. My debtor will be paying only on a delayed basis. Are you really with me? Then for working capital requirement, my dear lovable students, I have to take a loan from a bank. For that loan, I am liable to pay interest at the rate of 15% or another working capital loan is available at the rate of 14%. But this guy is asking 18%. But this guy is asking 18%. Actually, for interest rate, factor is costly because If I am taking loan from bank to the bank, I am liable to pay interest at the rate of 15% or working capital loan at 14%. But this factor is saying that, sir, do you have any receivable? Is receivable an asset? You sell the asset to me. I will give the amount in advance. Sir, that means factor is going to provide me the money in advance. Are you all really with me? That is not his job. His job is only to collect the money, not to provide the money. That means a factor is not only providing the factoring services, but also providing the, sir, bank loan services. Are you all really with me? For that factor is asking a service commission of how much percent? 8 commission of 2%. That is for collection. Since he is giving money in advance, he is asking 18%. Are you all really with me? Yes, sir. You are also present at the meeting. Being a financial consultant, CFO has asked to be ready with the following question. Consider an year as 360 days. This is the, sir, data. Pakka typical factoring question. By this question, we can revise the concept of the factoring. Let me ask you some basic question. Sir, you just be with me. Just throw the answers in the question. What is the total sales of the company? 200 lakh. This includes both cash sales and credit sales. Cash sales is not our discussion. Only credit sales are discussion. How much percent credit sale? 80%. That's what, sir, 200 lakh into 80% comes to 160 lakh. Right, sir? My dear lovable students, sir, what is the debtors collection period? We already discussed 80 days is the debtors collection period, right? In the sense, question specifically said that 50% of the debtors are giving within 40 days and remaining 50% within remaining 40 days. Are you all really with me? Because total 80 days is the average collection period. Are you all really with me? Total 40, sir, 50% 20. Here 120, 50% 60. So 20 plus 60 comes to, that's what they have written. 160 they have bifurcated into 1:1 ratio. Because 80 lakhs and 80 lakhs. Because some people are paying within 40 days. Some people are paying within average. That means, sir, this guy 20 days and this guy 60 days. Total comes to 80 days. Are you all really with me? Question. Indirectly using that, half of the customer, look man, past experience of the company is that average out of the total means how much percent? 100%. 50% of the customer avail of what? Discount. And balance of the receivable are collected in average in. So come on, in this question, what is the total sale? 200 lakhs. How much percent credit sale? 80%. So what is the total credit sale? 160 is the total amount. In that half, 80 lakhs. So 80 lakhs of the amount will be paid within 40 days. Remaining 80 lakhs will be paid within 120 days. Right? Already I calculated average collection period when I read the question itself as how many days? 80 days. Let me ask you a question. Is this 200 lakh 1 year sale or 1 day sale? Yearly sale, annual sale. So take your calculator. Sir, total, how much lakhs? 1 crore 60 lakhs is the total credit sales. 1 crore 60 lakhs into what is the average collection period? 80 divided by 360. Question said that please assume how many days in a year? 360 days in a year. That means 35 lakh 55,556 is the average receivable. Average receivable is 35 lakh 55,556. What they want? Average receivable of the company. First question understood? That's what, man. Sir, option for 1, option B, 35 lakh 55,556. Sir, think. In a year, how much total sale? 200 lakhs. I want the figures. 200 lakhs. In that, how much percent cash sale? 20%. Appa, how much percent credit sale? 80%. Appa, total credit sales is equal to 200 lakhs into 80% comes to 160 lakh. Is this 160 lakhs is for 1 year or 1 month? 1 year. But the average debtors collection period is only how many days? That means 160 lakhs into 80 divided by 360 comes to 35 lakh 55,556. Can I proceed? Now I'm moving into the second question, my dear lovable students. How much advance factor will give against receivable? So for the company, this much amount, 35 lakh 55,556 is what receivable from debtor. I am the company, I am calling the factor and I am saying to the factor that, Pa Thambi, you take this amount receivable. You collect this money, Pa, from the debtor. That means he is a service provider. I am the service recipient. I have to pay him consideration. That consideration is 2% of the total debtors. Are you all really with me? So I have to pay him what? Commission. I have to pay him what? Commission. Are you all really with me? Now, this out of 35 lakhs odd amount, he will be collecting from the debtor. Are you all really with me? Yes, sir. Actually, it's a process of collecting money from the debtor. By that time, some debtors will run away. That means bad debts may come. It is a responsibility of the factor to take care of the what man? Bad debt. You have to go and collect the amount without bad debt. You have to go and collect the amount without bad debt. Sir, now this out of 35 lakh 55,500 and what 56. Hello, sir. What factor will do? Some portion he will keep as reserve. He will keep as 100% of the money on day one. He will not pay to me. Have I sold debtors to him? Have I sold debtors to him? Actually, what he has to do, he has to go and collect from the debtor on day-by-day basis. He will be getting money. That money he will give to me. And from that money, I have to pay him commission. Concept clear? What I am saying to the factor that, hey, Thambi factor, I want money in advance. That means he is not only providing the factoring services, but also providing the banking services. For that, he will be charging what? 18% interest. Basically, interest. The question based upon 18-16 will change. Correct? My dear lovable students, now factor will say that, sir, we are having an agreement. Okay, sir, and I have to collect money from whom? Debtors. Sir, let me complete 100% of the transaction. I will not advance you 100%. If I advance you how much percent? 100%. Tomorrow what? Sir, you will say no. Hey, for me, whatever I have to get money, I have got it. Sometimes tomorrow some issue may come with the what? Debtor. At that time, I will say that, sir, he is not giving money. Please have a call, sir. One call you make, sir. He is having some issue. You are saying that the bill amount is 10 lakh rupees, total bill raised. He is saying that it is only 9 lakh rupees. After that, he is showing some debit note, credit note. Under your letterhead, have you really issued a debit note, credit note? Like that, some panchayat will come in future. At that time, if I get 100% of money, will I respond to him? Never. So for that purpose, sir, this factor person will never give me 100%. He will be, sir, keeping some amount as reserve. Keeping some amount as reserve. Are you all really with me? So I have to pay him what? Commission. Who has to pay? Company has to pay. It's an expense for the company. It's an income to the factor. Transaction understanding. Number 2 man, he will be, sir, holding somewhat reserves. Now you match it. Sir, what is the average level of receivable? 35 lakh 55,556. This is the debtor I sold to the factor. This is the amount of debtor I sold to the. So this is the amount factor is going to collect from the debtor. For that only I have to pay commission to him. So that's what factoring commission. How much percent? So 35 lakh 55,556 into 2 by 100 comes to 71,111. Sir, I have to pay him commission. You just think, who will receive the money? Factor will receive the money. How much he will ultimately receive? 35 lakh 55,556. And that means that 35 lakh 55,556 factor have to give to company. How much I should give to him? 71,000, sir, 111. Correct? That means you are going to give me 35 lakh 55,556. I am going to give you 71,111. We will do one thing better. We will net off. Balance you give to me. Nyayama. Accepting. Next one. Factoring reserve. What reserve, man? Factoring reserve. So you are not only going to collect money from the debtor, but also you are going to provide me fund. Will you provide 100%? No factor will do 100%. I said the logic why, what are the reasons. So out of 35 lakh, 55,556, he will be holding how much percent? 10% of 3 lakh 55,556. Logic, come on man. How much is the total debtor? 35 lakh 55,556. Out of this, you are going to collect, I have to pay you what? Commission. I have to pay you what? Of how much percent? So 35 lakh 55,556 into 2 by 100 comes to 71,111. This I have to pay to you. Logic clear? Less, sir, reserve. How much percent reserve? So 35 lakh 55,556 into 10 by 100 comes to 3 lakh 55,556. That means the balance amount you will give to me as advance. Balance amount you will give to me as advance. Are you all really with me? Calculator. 35 lakh 55,556 minus 71,111 minus 3 lakh 55,556 comes to 31 lakh 28,800. And so this is the amount you are going to give me on day number 1. For this amount only I have to pay interest to you. For this amount only I have to pay. That's what, man. Amount available for advance is 31 lakh 28,889. Are you able to appreciate? For this I have to pay what? Interest. How much percent interest? 18% interest. That's what? 31 lakh 28,889 into 18 divided by 100. What is the average collection period? 80 days into 80 divided by 360, because you are not going to provide for entire 1 year, because within 80 days you will get the money. Are you all really with me? So 1,25,156 interest I have to pay to you. Again it is going to be an expense for me. Am I right? Are you all really with me? Are you all really with me? That's it, man. The advance net amount as a factor you will pay to me 30 lakh 3,733. Point clear? What they want in the second question. The second question, how much advance factor will pay against receivable? What is advance is going to pay? 30 lakh 3,733. Is there any option C? For second one, option C is the answer. What is the annual cost of factoring to the company? Is there any cost to the company? Commission is a cost. Interest is a cost. Are you all really with me? That's what we are going to calculate, man. Annual cost they want. Look at the MCQ. They want the annual cost. Sir, this is factoring commission. Already we find out how much? 71,111. This is for how many days? 80 days. So we put into 80 by 360. Now put ulta. 360 by 80. You will get the annual cost of 3,20,000. Can I proceed? Interest charges, my dear lovable students. Sir, I have to pay interest of 1,25,156 for how many days? 80 days. So into 360 divided by 80, this much you will get. So 8,83,200 will be the annual cost. 8,83,200. Look at the option, 8,83,200. That means I am going to incur 8,83,200. Correct? Sir, all these activities earlier I only have done. I incurred the collection charges. I incurred the bad debts. Sir, is there any net cost to the company? Yes. What is net cost? Savings minus cost what I am incurring will be the net cost. Right? What is the saving? Company savings on taking factory. If I hand over my receivable to a person called as factor, my dear lovable students, on an annual, I am not supposed to spend 2,40,000 to monitor the debtors. Are you understanding? And bad debt. Sir, on 1 crore 60 lakh, on credit sales only bad debt will come. 1% can be avoided. 1,60,000 can be avoided. That means 4 lakh rupees no need to incur. But if I am going to factor 8,83,200, I have to incur. Are you all really with me? So the net cost to the company will be 4,83,200. Sir, this looks the cost is higher, no sir. Then why are you going to the factor? Such questions should not come because this include interest charges also. Now you are getting the money in advance, man. Hello, sir. If you are not going to factoring, your debtor will pay the money only within 120 days, man. Till that 120 days, you won't have the money. You have to go to a bank and you have to get the working capital loan at the rate of 15% or 14% as the case may be. That means the net cost, what you are going to spend is 4,83,300. That's what option 4, man. 4,83,200, whatever it may be. What is the effective cost of factoring an advance received? Sir, effective cost of factoring. What is the net cost? 4,83,200. Am I right? Am I right? How much is that net advance you received? What is advance received amount? 30,03,733. So cost divided by this advance. Sir, 4,83,200 divided by 30,03,733 comes to 16.09. 16.09. Are you all really with me? If I am going to a loan 14% interest, either 15% interest, but for factoring I am spending 16.09. Now the management have to take a decision that whether they have to go for the what or not, factoring or not. That and all have not been asked in the question. Are you all really with me? One case scenario, one factoring concept has been completed. Are you all really with me? So how to proceed factoring? The same question can be tested in, sir, descriptive part. Then simple. You have to take the total sales. Total sales should be bifurcated into two categories. Less what sale? Cash sale. You will get the, on this credit sale, apply the average collection period. Am I right? On credit sales, if you apply average collection period, you will get the average datas. On this average datas, this is the amount you are going to get as money from the factoring. Let me ask you a question. Why are you going for factoring? Why are you going to a factor? Because instead of managing myself the debtor, it's better the debtor be handled by factor. Hello, sir. That means no need to cry. Why you have to cry? Are you all really with me? Why you have to cry? Hello, sir. Let him cry. Let whom cry? Factor cry. Let him take the headache of the collecting the money, bearing the what man, bad debts, etc. We be jolly. Today itself we'll be getting money. No need to what? Cry. That's what they are saying. Don't cry. Minus C. C stands for what? Commission. Minus R. R stands for what? Reserves. Minus I. Interest. Don't cry. Let him cry. Are you all really with me? Balance you will be getting. 5 mark will be in your pocket. That's it with regard to case scenario number 1. Yes, sir. We are going to start the discussion of case scenario number 2. Tiago Limited is a all equity company. All equity company means 100% of the capital structure comprises of equity. Engaged in manufacturing of battery for electric vehicles. There has been surge in demand for their product due to rising oil prices. Company was established 5 years ago with an initial capital of 10 lakhs. That means when the company started, they start up with 10 lakh. And since then it has raised fund by IPO, taking the total paid up capital to 1 crore, comprising of fully paid equity share of the face value of rupees 10 each. That means today it's an all equity company. There is no debt component in the capital structure. Entire 1 crore represents equity share capital. Company currently has undistributed reserve of how much lakh? 60 lakhs. That means, my dear lovable students, the current equity share capital is total 100 lakhs and reserves and surplus is 60 lakhs. So total comes to 160 lakhs is the current capital employed of the company. And that is 100% equity. It's all equity company. Company has been following constant dividend payout of 40%. That means, my dear lovable students, dividend payout ratio is equal to 40%. That means retention ratio is equal to 60%. Super, sir. Of the earnings. Sir, the retained earnings by company are going to provide a return on equity of 20%. That means our rate of return on retained earnings is equal to 20%. That means if company holds the money, company will give a return of 20%. Current EPS is rupees 20. Basically, EPS 0 is equal to 20 per share is the details given. And prevailing PV ratio of the company is 15x. 15x means 15 times. That's it. So the price earning ratio is equal to 15x. As we all know that price earning ratio is equal to MPS divided by EPS. So 15 is equal to MPS divided by 20. We can crack the MPS. MPS is equal to 15 into 20 comes to 300 rupees per share is the current market price. Instead of saying indirectly, they said indirectly. Okay, fine. Company want to expand its capital base by raising additional fund by way of debt, preference and equity mix. Super. Now, the company is an all equity company. They want to change the composition. They want to, add debt. They want to add preference. They want to add what? Equity. Already equity is there. So they are going to add debt and preference. Company requires an additional fund of how much crore? 1.2 crores. Basically, existing share capital is 100 lakh rupees equity plus 60 lakh rupees reserves and surplus, total 160 lakh. Add additional capital required 120 lakhs. So total capital after issue of fresh issue will be 160 plus 120 comes to 280 lakhs. Fine, fantastic to the core. The target ratio of owned fund to borrowed fund is 4:1. Out of this 280 lakh, it should be classified into two categories. Sir, basically equity is to debt. What should be the ratio given? Dash is to dash, 4:1. So 280 lakhs into 4 by 5 should be equity and 280 lakhs into 1 by 5 should be debt. So use your calculator. 280 into 4 by 5 comes to 224 lakhs should be equity. Basically, equity comprises of equity share capital plus reserves and surplus plus preference share capital or preference shareholders fund. Sir, 280 into 1 by 5 comes to 56 lakhs is the debt component, which is basically the debt. Fine. So the target ratio of owned to borrowed fund is 4:1 post the fundraising activity. In that, capital gearing is to be kept at 0.4x. As we all know that capital gearing ratio is equal to debt plus preference share capital divided by equity shareholders fund. This should be equal to 0.4 divided by 1. That means total debt plus preference share capital is 0.4 and equity shareholders fund is 1. So my dear lovable students, sir, the total capital employed is equal to 280 lakhs. So out of that 280 lakhs, we are having classification of debt plus preference share capital and equity shareholders fund. So debt plus preference share capital is 280 lakhs into 0.4 divided by 1.4, which is nothing but 0.4 plus 1 is equal to 1.4. So 280 lakhs into 0.4 divided by 1.4 comes to 80 lakhs. 80 lakhs is debt plus preference share capital. Sir, this 80 lakhs comprises of debt plus preference share capital. Already, we know that debt has been calculated at 56 lakhs. So if debt is 56 lakhs, 80 lakhs minus 56 lakhs comes to 24 lakhs is the preference share capital. Super, sir. Come to equity share. 280 lakhs minus 80 lakhs comes to 200 lakhs is the equity share capital. This comprises of, my dear lovable students, old equity plus new equity. Already old equity is 100 lakhs of equity share capital plus 60 lakhs of reserves and surplus, so 160 lakhs. Accepting? So 200 minus 160 comes to 40 lakhs is the fresh equity I am supposed to be raised. I have analyzed that in a very, very detailed way. The existing debt market are under pressure due to ongoing RBI action on NPA of the commercial bank. Kada. Due to challenges in raising the debt fund, company will have to offer rupees 100 face value debenture at an attractive yield of 9.5%. That means currently the face value of one debenture is 100. But if I issue at 100, the debenture holders will not buy it. Okay. So I have to give at a very discount price. At a coupon rate of 8% to the investor. And every year he is supposed to get 8% as return. That is interest. Issue expense will be amount to 4% of the proceeds. That is flotation cost they are talking about. They are coming to the next source. Preference shares will have a face value of rupees 1000 each, offering a dividend rate of 10%. That is the PD preference dividend. Preference shares will be issued at a premium of 5%. So issue price is equal to 1000 into 105% come to 1050. Whereas, sir, redemption value is equal to 1000 into 110% comes to 1100. So there is a loss. After 10 years, that means the life is equal to 10 years. At the same time at which debenture will be redeemed. That means debentures are also irredeemable debentures. The life of the debentures is 10 years. Even the preference shares are also redeemable preference shares, not irredeemable. Redeemable debentures and redeemable preference shares. Even the life of preference shares is also 10 years. The CFO of the company is evaluating a new battery technology to invest the aforesaid money. They have raised the additional fund. They are going to invest the additional fund. Basically, capital budgeting details has been given in the question. Technologies expect to have a life of how many years? 7 years. It will generate the after-tax marginal means additional, operating cash flow of 25 lakhs per annum. Assume marginal tax rate to be 27%. Generally, additional tax rate is going to be 27%. So what are the requirements? Which of the following is the best estimate of cost of equity? What is the KE of the company is the question. As we all know that KE can be found out by DPS 1 divided by MPS 0 plus GE into 100. Which of the following is the most accurate measure of issue price of debenture? Because as we all know that face value of one debenture is 100. But if the company issues one debenture at 100, no debenture holder is ready to buy. So we have to issue at a discount. So what is the correct issue price is what the question. So most accurate means approximation method will not be applicable. YTM method will be applicable. YTM means IRR method. Are you all really with me? Yes, sir. IRR method. Which of the following is the best estimate of cost of debenture to be issued by the company? Now, in this question, they are asking KD by using the approximation method. We all know that KD is equal to I into 1 minus T plus RV minus NP divided by N whole divided by RV plus NP divided by 2 into 100. Are you all with me? Calculate the cost of preference share using approximation method, not the YTM method. As we all know that KP is equal to PD plus RV minus NP divided by N whole divided by RV plus NP divided by 2 into 100. That's a formula. We have to place the numbers into it. We will. Which of the following best represent the overall cost of marginal capital to be raised? That means we know that there are two things are there. Weighted average cost of capital, weighted marginal cost of capital. They don't want weighted average cost of capital. Sir, they want only weighted marginal cost of capital. While doing this question, wherever possible, I will try to explain, sir, instead of just doing. First one, KE is the, sir, finding out. Can we find out KE together? In the sense means, as we know that KE is equal to, cost of equity is equal to DPS 1 divided by MPS 0 plus G. Basically, this is the cost company will be incurring. This is the amount company will be paying to the equity shareholders. Sir, company will not pay the current year dividend. Company will be paying the next year dividend. So the equity shareholder is expecting DPS 1. So that's what the cost the company is going to incur. Sir, in order to enjoy DPS 1, you have to invest MPS 0 with the company. That's what the capital. That's why cost of capital chapter, cost divided by capital. Sir, plus G, growth rate will be there. So what is the DPS 1? DPS 1 is actually EPS 0 is given in the question. As what? 20. Sir, G growth rate is equal to B into R, which is nothing but retention into rate of return on the retained earnings. Sir, they said that dividend payout ratio is equal to 40%. That means the retention ratio should be 60%. And R given as 20%. So G is equal to B into R. What is B? 60% they are retaining. It should grow at 20%. So 12% should be the growth rate. My dear lovable students, I am having EPS 0 in my hand. I want EPS 1. So EPS 1 means grown EPS, which is 20 into 112% comes to 22.4. This is the EPS 1. I know that, sir, DPS 1 is equal to, DPS 1 means grown dividend. Actually, DPS 0 has not been given in the question. So DPS 1 means EPS 1 into dividend payout ratio, which is 22.4 into, what is the dividend payout ratio? 40%, comes to 8.96. So this is what next year the equity shareholder is going to enjoy. So 8.96 is the DPS 1. We already calculated MPS 0 by, sir, using the PE ratio. So 300 rupees is the MPS 0. Plus G is 12%. So basically 8.96 divided by 300 into 100 plus 12%. So the expectation of the equity shareholder is 14.99%, technically 15%. If they straight away given 15, it's okay. Otherwise 14.99. For this question, sir, option D, 14.99% is the answer. I hope that you are very comfortable with the calculation of the KE. Basically, in the ICAI illustrations and all, straight away everything will be given. Here we have to calculate everything. I hope that the explanation is clear. Which of the following is the most accurate measure of issue price? Basically, this is valuation of debenture, not the KD. They are asking, if you are issuing debenture at 100, debenture holder is not interested to buy. Then at what is the ideal price for the debenture? So the ideal price for the debenture, we have to understand the concept number 2 in financial management, which is nothing but value of an asset today is equal to present value of its future cash flows. So they are asking value of an asset today. What should be the value of the debenture? It depends upon what cash flow it will generate, which is nothing but year, cash flow, present value factor, and discounted cash flow. Actually, the life of the debenture is 1 to 10 years. Every year, debenture holder will get a coupon rate of 8%, right, sir, on its face value. So 100 into 8% comes to 8 rupees is the interest the debenture holder will be getting. They themselves given in the question that attract a yield of 9.5%. That means yield means the discount rate, basically the IRR, basically the YTM. So present value factor at 9.5%. What you are supposed to do? You have to take the calculator. 1 divided by 1.095, sir, is equal to or is equal to into is equal to for 10 years. You will get the cumulative present value factor. For how many years? 10 years. What is the cumulative present value factor? 6.2788. So 6.2788 into 8 comes to 50.2304 is the present value of the future cash outflows. And on 10th year, the redemption value 100 rupees we will be paying. Company will be paying 100. For that, don't take the cumulative present value factor. You have to take the present value factor at the end of the 10th year at 9.5%, comes to 0.4035. So 100 into 0.4035 come to 40.35. So 50.2304 plus 40.35 comes to 90.58 is the ideal price of the debenture. So 90.58, option number C, 2C should be the right answer. 90.58. The same only given, sir, by the ICAI also. My dear lovable students, I believe that you are very comfortable with the second calculation. I'm moving into the third calculation. Which of the following is the best estimate of the cost of debenture to be issued by the company? That means they want KD. For KD, either we can use the YTM method or we can use the approximation method. So they want the third requirement in the question. Sir, KD, first question to you, is the debt redeemable debt, irredeemable debt? Redeemable debt. Then I into 1 minus T plus RV minus NP divided by N whole divided by RV plus NP divided by 2 into 100. This is the formula to find out the KD, cost of the debt. My dear lovable students, I means interest, always it has to be calculated on the face value. So 100 into 8 percentage come to 8. Into 1 minus marginal tax rate has been given in the question as 27 percentage. Comes to 0.27. Plus redemption value means the value at which I will be paying at the end. I will be paying 100 rupees. Are you all with me? The net proceeds is the hero in the question. Sir, net proceeds means what I will be getting. Sir, the face value of the debenture is 100. My dear lovable students, nobody is ready to buy at 100. That's why I find out the ideal price as 90 point. So issue price is equal to 90.58. But out of that issue price, if I am having any flotation cost, that has to be reduced. That's why, sir, issue expense will be amount to 4% of the proceeds. So 90.58 into 96%, which is nothing, 100 minus 4%. So 86.96 is the total issue price. So 100 minus 86.96 divided by the life is 10 years. Whole divided by, what is the redemption value? 100 plus 86.96 divided by 2. So basically, sir, 8 into 73% comes to 5.84 plus 100 minus 86.96. You will get the capital loss of 1.304 divided by 10 years. After, so 13.04 divided by 10 comes to 1.304 whole divided by the average liability, which is opening plus closing divided by 2, comes to 93.48 into 100. Basically 5.84 plus 1.304 comes to total 7.144 divided by 93.48 into 100 comes to 7.64% is the KD we are getting. We have to go and check. Do you have an option? Sir, 7.64%. We got 3A. Sir, option 3A, 7.64%. The same only they also have been worked out. Since it's a revision, I'm doing once again. Can we do the fourth MCQ, my dear lovable students? Calculate the cost of preference share using approximation method. Now, the next requirement is KP. Cost of preference share is equal to PD plus RV minus NP divided by N whole divided by RV plus NP divided by 2 into 100. It's fantastic, sir. Preference dividend, always it has to be calculated on the face value. 1000 rupees is the face value they said, and 10% is the preference rate. So 1000 into 10 comes to 100 is the preference dividend. Plus redemption value, already we calculated RV as 1100. Minus, what is the net proceeds, man? 1050 is the net proceeds, divided by life is 10 years. Divided by 1100 plus 1050 divided by 2 into 100. So my dear lovable students, 100 plus a capital loss of how much rupees, man? 50, yeah? 50. It has to be spread over a period of 10 years. So basically 5. Divided by average liability of 1075 into 100. So basically 105 divided by 1075 into 100 comes to 9.77% is the KP. I have to check that 9.77%. For question number 4, B should be the right answer. 9.77, the same only even I have also worked out. The last question. Which of the following best practices is the overall cost of marginal cost to be raised? My dear lovable students, a beautiful requirement. This is what the I love you area in this question for me. Sir, if you see, we have actually worked out the source. We are having equity share capital, preference share capital. We are having reserves and surplus. We are having debt. Are you all really with me? What is the existing equity share capital? 100 lakhs. Plus, I already find out when I explained at the initial time, the new equity share capital is 40. So 100 plus 40 will be what? 140 is the total equity share capital. What is the preference share capital you are going to issue? We have find out as balancing figure, the preference share capital is 24 lakhs. 24 lakhs. Super, sir. That I'm downloading 24 lakhs. What is the reserves and surplus? Already 60 lakhs. Debt based upon the debt equity ratio, we find out that 56 lakhs. Take calculator. 140 plus 24 plus 60 plus 56. 280 lakhs. This is the total capital employed. My dear lovable students, if I am calculating the WACC, sir, if I am calculating the KO for this 280 lakh, that is called as weighted average cost of capital. Whereas I am ignoring 100 lakhs, I am calculating only for what? 40 lakh. Sir, I am calculating for 24 lakhs because that is the fresh capital which I have issued. Reserves and surplus I will not consider, my dear lovable students. Debt I will be considering because earlier it was a all equity company. Now the capital structure has been changed. So 40 plus 24 plus 56 comes to 120 lakhs. If you read the question, they were having a highlight of 120 lakhs. For this 120 lakhs, what is the cost of capital if I calculate? That concept is called as marginal cost of capital. Wow. So this is never called as WACC. This is called as WMCC, weighted marginal cost of capital. Fantastic concept, sir. Those who are seeing this will really have a good feel that, wow, fantastic. Now I can calculate the proportion. Fantastically, I can calculate the proportion. 40 lakhs divided by 120 lakhs comes to 0.33. So I will be writing 40 divided by 120 itself because kacha mocha is coming. Sir, 24 lakhs divided by 120 lakhs and 56 lakhs divided by 120 lakhs. Total comes to 120 lakhs, basically equal to 1. I know the individual cost of capital, which is KE, already be calculated in requirement number 1, comes to 14.99%. We already just now finalized the KP. KP is equal to 9.77%. We calculated KD using approximation method as 7.64%. So basically I have to multiply, my dear lovable students. Tell me 14.99 into 40 divided by 120 comes to 4.95%. 99%. 4.99%. You can round off to 5 also because 4.99999, some round of difference will be there. Take into 5% also. 9.77 into 24 divided by 120 comes to 2%. 7.64 into 56 divided by 120 comes to 3.56. So 5 plus 2 plus 3.56 comes to 10.52% is the KO. This is not technically called as weighted average cost of capital. This is technically called as weighted marginal cost of capital. Is there any 10.52% answer? We got 10.52. There is option A, 10.52%. This is what they have also done. They have also done by using a table. I have given a detailed analysis. My dear lovable students, with this we are done with case scenario number 2. Yes, sir. We are going to start with case scenario number 3. K Limited, which is shortly called as KBL, has completed 35 years of operations in India. That means they are talking about the history. It has many subsidiary and associate company in more than 100 countries. That means it is not established in one place, it is established many places. KBL's business include home and personal care, food and beverages, and industrial agriculture and other products. That means they are dealing with not one product, they are dealing with many products. It is one of the largest producers of soap and detergent in India. The company has grown organically as well as through acquisition. Over the years, company has built a diverse portfolio of powerful brands, some being household names. After reading this, what we understood, the most irrelevant paragraph has been given in the case scenario. That means ICAI want to increase the length of the case scenario. For that they are saying some story, irrelevant story. Leave it, put it on dustbin. It is planning to acquire one of its competitors named Prestige Limited, which would enhance the growth of KBL. Fine, then now the real story starts. Consideration amount will be 1.5x of its average market capitalization. First of all, what is this word market capitalization? Market capitalization means number of shares into market price per share, my dear lovable students. So you have to see the Prestige Limited's number of share into what is the market price of share will be the purchase consideration. It is same like our amalgamation. Prestige Limited has 1,30,000 outstanding equity shares. And its shares are traded at an average market price of what? 45. Basically, 1,30,000 into 45 per share comes to 58,50,000 will be the purchase consideration, which is going to be paid by KBL Limited to the Prestige Limited. Fine. 45 as on valuation date. The consideration amount will be paid equally in 5 years. Super, sir. They are not going to make the payment in one shot. They are going to make the payment in 5 years. Where the first installment is to be paid immediately. They are starting the game from here, my dear lovable students. In the sense means, we already calculated number of shares is equal to how much? 1,30,000. Tell me, what is the market price per share? Market price per share is equal to, so total purchase consideration is equal to 1,30,000 into 45 comes to 58,50,000. This is going to be paid in 5 installment. So divided by 5 comes to 11,70,000 will be the payment. In this Y0, Y1, Y2, Y3 and Y4. Because today, now they will pay 11,70,000. For that, the present value will be 1 itself. Whereas the next 11,70,000 will be paid at the end of the first year. The next 11,70,000 will be paid at the end of the second year. Next 11,70,000 will be paid at the end of the third year. Next 11,70,000 will be paid at the end of the fourth year. Even though 5 installment, 1 installment is in advance. I'm continuing the question. Prestige Limited has KO of 15%. Prestige Limited's KO is 15%. That means KO means overall cost of capital. This is the KO of the Prestige Limited. KBL will raise the fund required through debt and equity in the ratio of 30:70. Now KBL have to settle the purchase consideration to Prestige. So KBL need fund. They are going to raise in the ratio of 30:70. That means debt will be 30 and equity will be 70. Fine. Company require the cost of capital, estimates for evaluating its acquisition, investment decision and performance of its business. Fine. KBL share price has grown from 150 to 301 in the last 5 years. That means before 5 years, the share price of our company was 150, but it has grown to 301 in the last 5 years. And it will continue to grow at the same rate. That means growth rate, whatever growth rate we are having in the last 5 years, which we are going to be having in the future also. KBL pays dividend regularly. They used to pay dividend. Company has recently paid a dividend of what? 8 rupees. This is called as DPS 0 because already paid. For the calculation of equity, an average of 52 weeks high market price in the last 5 years is to be considered, which is as follows. That means market price 185, 210, 252, 325, 280. My dear lovable students, 185 plus 210 plus 252 plus 325 plus 280 divided by 5. This will be the average market price. Comes to 250.40 should be the MPS 0, my dear lovable students. That means when we are calculating KE, as we all know that KE is equal to DPS 1 divided by MPS 0 plus G. We have to find out the G, growth rate. Fine. DPS 1 is nothing, DPS 0 into 1 plus G. MPS 0 only I have worked out, 250.40. KE calculated as per growth model holds a weight of 0.6%. This is the good twist. We are calculating KE as per Gordon's model. Sir, that KE will only count for 60%. That means company also wishes to calculate the equity expectation using CAPM. which hold a weight of 40%. So what is the question saying? First, we have to find out the KE as per the Gordon's model. You will get 1 KE. That KE into 60% is one part of KE. Then calculate the KE as per CAPM. That answer into 40%. So you have to add the 60% as per Gordon and 40% as per CAPM will be the total KE. For the purpose of calculation of the CAPM, risk-free rate is assumed as yield on long-term government bond. Company regarded as 8%. That means RF is equal to 8%. KBL regards the market premium, market risk premium. Risk premium is equal to 11%. Premium in the sense means RM minus RF. Premium in the sense means RM minus RF. That means that extra what I will be getting. That is called as premium. Securities premium is over and above the surface value. Its estimation on the beta is 0.78. So 0.78 is the beta. It is not even 1. So I know that sir, K is equal to RF plus beta into RM minus RF. KBL issued debenture. Now they are coming to the debt because they have to raise the fund to settle to the that prestige company because they're going to acquire some company. No, that debt equity ratio is what is to what? 30:70. So 30% should be debt. KBL issued debenture with face value of 10,500. Appa, one debenture face value 10,500, which is to be amortized equally over the life of 7 years. That means 10,500 divided by 7 years comes to 1,500. Every year they will repay 1,500. That means the debt is a redeemable debt. That to amortization of bond. Company consider the effective rate of applicable to a AAA rated company with the markup of 200 basis point. 200 basis point means 2%. Are you all with me? If it is 300 basis point means 3%. As it is coupon rate. That means it thinks that considering trend over the years, AAA rate is how much percent? So 7.5% plus 2% comes to 9.5% should be the KD. Ignore taxation. So 1 minus T concept will not be applicable. Based on the above details, answer question 1 to 5 is the question. Super question, man. I took nearly 10 minutes to read the question. I have analyzed everything. Now we can start answering one by one. Calculate the cost of equity under both the method is the question. There are 2 methods given. So we have to calculate as per 2 methods. So KE, number 1. Actually, nowhere, sir, we will be solving KE like this. We will be separately only calculating a brilliant, fantastic, outstanding. I love you, ICAI. This is the reason why I always love ICAI. Number 1, Gordon's model. And number 2 is CAPM model. Right, sir? Sir, as per Gordon's model, the weight is 60% and CAPM model weight is 40%. Am I right with the weight? Sir, Gordon's model KE is equal to DPS 1 divided by MPS 0 plus G. Sir, CAPM model KE is equal to RF plus beta into RM minus RF. It's very easy to calculate CAPM. So we'll finish it off that. What is RF risk-free rate? 8%. Plus what is the beta of this company? 0.78 into premium given as 11%. So everyone take your calculator, my dear lovable students. Sir, 11 into 0.78 plus 8. So 8% plus 0.11 into 0.78. 8.58. Right, sir? 11 into 0.78 comes to 8.58. Plus 8 comes to 16.58 is the KE as per CAPM. But I'm not going to take this 100%. Only I'm going to give a weight of 40%. Here the game is with the Gordon. Game is with the Gordon means, sir, whether you are properly finding out the growth rate or not is a matter. My dear lovable students, they are saying that if you are traveling 5 years before, the market price of the share was 150 rupees. Am I right? But today, after 5 years, the market price has been reached to 301 rupees. That means this is like future value when you are standing here. This is like present value when you are standing here. Sir, we all know basic 10 standard max. Future value is equal to present value into 1 plus r raised to n. What is the future value? 301. What is the present value? 150. Into 1 plus r, that is a growth rate that I don't know, raised to n is 5 years because it has grown to 5 years. Simple, basic max. Sir, you are going to deposit an FD today. The value of the FD is 150 rupees. The year life is equal to how many year? 5 year. The bank is going to give you some rate of interest. After 5 years, that FD value will become 301. Are you really with me? That means 301 divided by 150 is equal to 1 plus r raised to 5. So 1 plus r raised to 5 is equal to, calculator, 301 divided by 150 comes to 2.0066 or 67. So 1 plus r should be equal to 5th root of 2.0067. This is where, if it is 4th root, simply we will put the root 2 times. Game over. But my dear lovable students, this is 5th root. What we are supposed to do is, we have to go to the cumulative present value table. In that table, all the factors will be given. For example, sir, the rate may be, I don't know, sir, it may be 10% or 11% or 12% or 13% or 14% and so on. If that is the case, actually what is the meaning of this? First understand the meaning. For example, today I were having 1 rupees in my hand. If that 1 rupees has been deposited, after 5 years, it is becoming 2 rupees 0.67. Sir, at some rate it is growing. That rate is called as growth rate. I am assuming 10% as a growth rate. For example, 1 rupee will become 1.1 rupee. Correct? So, 1 rupee will become 1.1. So, take your calculator, will compound. 1 into 1.1, 110 percentage, for example. So, at the end of the year number 1, it will become 1.1. Correct? Sir, only 1 year I have compound. I have to compound to how many years? 5 years. That means, into again 110 percentage, second year compounding. Into 110 percentage, third year compounding. That means you will be getting 1.331. Into 110 percentage, fourth year compounding. Into 110 percentage, 1.61051 is the answer you are getting. That means if 1 rupee, if you compound at 10 percentage, it will become 1 rupee 60 paise. I have to get 2 rupees. So I understood that it is not 10%. I am trying at 12%. I don't know. Sir, I am trying 1 rupee into 112 percentage. Calculator, everyone. 1 into 112%. It will become 1.12 at the end of the first year. Again into 112 percentage. 1.2544. Into again 112 percentage. 1.404928. Into 112 percentage. 1.5735. Into 112 percentage. 1.7623. I understood that, sir, even 12 percentage is also not the growth rate. Sir, I am trying at 15 percentage, my dear lovable students. Sir, calculator, because I am skipping some numbers and randomly I am doing. 1 into 115 percentage comes to 1.15. Into again, sir, 115 percentage, 1.3225. This will be the value at the end of the second year. Into 115 percentage, 1.520875 will be the value at the end of the third year. Into 115 percentage, 1.749 something. Into 115 percentage comes to 2.011. That means 2.0067. The growth rate is 15 percentage. Sir, this is trial and error method. I will never recommend this method. I just taught you, sir, the way in which you can find out this. This is method number 1, trial and error method. Method number 2, present value table. You go to the present value table. This compounding will be there. There you check. If 1 rupee has been grown at 15 percentage for how many years? 5 years. It will become 2 rupees. That is called as step number 2. Coming to step number 3, calculator trick. Because if it is 4th root, we will press the root 2 times or 1 time? 2 times. But this is 5th root. Sir, how to solve the 5th root, sir? Nothing. Just follow this 7-step approach. Always 7 nale success na. 7-step approach. Sir, just put the value in the sense means what is the future value? 301 divided by what is the present value? 150. Sir, everyone calculator should have this number. I don't know whether you are able to see or not my camera. 2.006 something something. Step number 1, press 12 times root. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Very good. Congratulations. Step number 1 you have done. Step number 2, do minus 1. Then I am going to calculate the fifth root. So divided by 5. You will be getting some figure. You have reduced minus 1. Just do plus 1. Then into equal to for 12 times. Into equal to 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Then you have to reduce minus 1. Why minus 1? Nothing. 1 plus r. Because 1 plus r, I want only r. So in order to get the r, I have to do the minus 1. So minus 1. Sir, I will be getting 0.149 into 100. Because always the growth rate should be expressed in percentage. Comes to 14.947, which will be round off to 15%. Will be the growth rate. Fantastic to the core. I got the answer as G is equal to 15%. Here is where I'm standing. So my dear lovable students, G is equal to how much percent? 15%. Now I can easily find out the DPS1. Am I right, sir? Sir, DPS1 is equal to DPS0 into 1 plus G. What is the DPS0? 8 into 115% will be the 1 plus G. Comes to 9.2 will be the DPS1. So 9.2 divided by what is the average, sir, share price? 250.40 plus 15% growth rate. Come on, man. 9.2 divided by 250.4. 9.2 divided by 250.4% comes to 15, comes to 18.67%. I will not say this is KE. This into how much percent? 60% is the weight. So into 60% comes to 11.204%. Plus, I have to give weight for what also? CAPM also. 16.58 into how much percent? So 16.58 into 40% comes to 6.632. Sir, plus 6.632. So 11.204 plus 6.632 comes to 17.836%. Should be the KE. As per our working, I have to go and check the ICAI answer. First of all, sir, calculate the cost of equity under both the method. The main answer they are asking before giving weight. Sir, we got KE under Gordon model and KE under CAPM. Are you all really with me? Sir, under CAPM, we got the answer as 16.58. Pakka, sir. 16.58. What I will do now? I will check is there any method CAPM. CAPM 16.58. Option C should be the right answer. Because the second one is CAPM. My CAPM answer is correct. Sir, coming to what model? Gordon model. We even worked out the Gordon also. As per Gordon growth model, 18.67 should be the right answer. Right, sir? They are having 18.65. Sir, 67 should be the right answer. We'll be checking. This is what option number 1. Option number C they have given. Take the calculator. 185 plus 210 plus 252 plus 325 plus 280 divided by 5 comes to. It's printing mistake in the ICAI. Wrong. You do with any calculator, you won't get this answer. Correct. So that's why that percentage mistake is there. So KE should be that answer, man. We are only right. 18.67 should be the right answer. Right, sir? First part we have done. Now we have cross multiplied this into how much percent? 60%. And this into 40%. We got one KE, 17.836%. 17.83. because A2 is A3. So for the second one, my dear lovable students, option A should be the right answer. Option A is the right answer. Fantastic to the core. Brilliant, beautiful question. Coming to the third requirement. Calculate the cost of debt if the intrinsic value of debenture today is close to 9,740. In a sense means intrinsic value of the debenture today means present value of the debenture today is 9,740. As we all know, sir, value of an asset today is equal to present value of its future cash flows. Are you really with me? In this debenture, what they are going to do is, sir, they are going to redeem it, right? Debenture, it's a redeemable bond. Every year they will be paying how much? 1,500 rupees. Along with what, man? Interest. So first year, actually this will be like the bond table. First year the bond outstanding will be, value will be 10,500. Accepting? They will be repaying 1,500. Then the balance outstanding will be 9,000. This 9,000 will be for year number 2. Correct? On that they will be paying 1,500. Then the balance outstanding will be 7,500. This year number 3, 7,500 will be opening. On that 7,500 they'll be paying 1,500. 7,500 from 1,500 gone mean 6,000. In year number 4, 6,000 will be there. From that they will be paying, okay, balance will be, in year number 5, 4,500 will be there. On that they will be paying 1,500. Balance will be 3,000. In year number 6, on 3,000 they will be paying 1,500. Balance will be 1,500. In year number 7, the outstanding will be 1,500. They'll be paying 1,500 and the bond table will close. Right, sir? And on this interest, on the outstanding balance, my dear lovable students, they have to pay the interest. Interest at the rate of already KD we worked out 9.5%. Are you all really with me? So in the first year, at the end, 10,500 will be outstanding. So 10,500 into 9.5% comes to 997.50 will be the amount of interest they are supposed to pay. In year number 2, sir, 9,000 will be the outstanding amount at the end. So 9,000 into 9.5% comes to 855 rupees. Sir, 7,500 into 9.5, yeah? 9.5. 7,500 into 9.5% comes to 712.50. 6,000 into 9.5% comes to 570. Sir, 4,500 into 9.5% comes to 427.50. 3,000 into 9.5% comes to 285. 1,500 into 9.5% comes to 142.5. That means the total cash flow which will be received by the debenture holder will be this 1,500 rupees of principal repayment plus interest. That means 1,500 plus 997.5. What is 1,500 plus 997.5 comes to? How much? 2,497.5. Come on, man. Come and check the answer. In the first year, that debenture holder will be getting 2,497.5. Sir, that I am going to discount using 10% present value. Are you all really with me? Sir, calculator. 1 divided by 1.1 comes to 0.90900 something. What is the cash flow we got? 2,497.5 into 0.909 comes to how much is the calculator answer you are getting? That's what? This 2270.45. Like that, you have to solve for every year. Nothing, man. You have to add all this. I'm not solving. That is, in the sense means 1,500 plus 855. Then you have to discount using 10% present value. 1,500 plus 712.5. Then you have to discount using the third year present value factor. 1,500 plus 570. Then you have to discount using the fourth year present value factor. 1,500 plus 427.5. Then you have to discount using the fifth year present value factor. 1,500 plus 285. Then you have to discount using the sixth year present value factor at 10%. 1,500 plus 142.5. Then you have to discount using the seventh year present value factor. Then you will be getting discounted cash inflow. Minus, already they said that intrinsic value of the bond is on today is 9,000 something they have given, right? 9,740 is the discounted cash outflow from the debenture holder. So this is what debenture holder is going to get in future. Sir, total 10,340. You tell me, this is the discounted cash inflow. What is the discounted cash outflow? 9,740. So surely you are having positive NPV. How much is the positive NPV? 600.14. That means I understood that 10% is not the rate. So since I'm having positive NPV, I want, sir, at IRR, my discounted cash inflow should be equal to discounted cash. I am raising the rate from 10% to do the same procedure at 15%. You will be getting 8,938 minus 9,740. Surely you will be getting negative NPV of 800.77. Now, if you interpolate, you will be getting IRR of how much percentage? 12%. What is the requirement of the question, man? Because when I solve, it will be like a descriptive question. It will take a lot of time. Sir, calculate the cost of debt. If the intrinsic value of the debenture today, cost of debt mean what? KD. They are asking at YTM. In the sense means, at YTM, IRR, discounted cash inflow should be equal to discounted cash. It should be at 12%. I hope that you understood how to crack the question. Calculate the WACC and the amount of purchase consideration. Already purchase consideration we calculated. Number of shares into market price per share. Sir, 1,20,000 shares into 30 comes to 1,30,000 into 45 comes to 58 lakh. I will check, is there any option 58 lakh 50,000? Then this is the answer. This is a smart way to find out the answer. So fourth one, option D should be the answer, my dear lovable students. Sir, option A, what is the answer? What is the number of share? 1,30,000 into amount of purchase consideration. No. Purchase consideration, they are paying how much? How much share? 1,30,000 into 45 per share. Huh? So 1,30,000 into 45 means 58,50,000 is the purchase consideration, right? They want the WACC. Actually, 58,50,000 rupees is the purchase consideration. So for us, option D is the answer we are getting. Correct? For them, for the fourth one, option C is the answer. We'll come and check. Sir, we'll be doing the WACC, weighted average cost of capital. Sir, what is WACC comprises of what and what? Source and the market. Source, we are having two sources. One is debt, other is equity. Correct? Debt, what is the amount of KD? Just now you find out. How much percent? 12%. What is KE? Weighted KE. Weighted KE is overall cost of capital is 17.82%. Correct? 17.82%. Sir, when I know the total purchase consideration only, I can bifurcate the purchase consideration in the ratio of 30:70. Correct, sir? Sir, they want the total PC. Sir, in question they are saying that the consideration 1.5x. We have calculated only 1x. That is a problem. So my dear lovable students, we got only 1. What is the 1? So 58,50,000 into 1.5 comes to 87,75,000. Is there any option of 87,75,000? Two options has been given. Now ICAI is very smart. So I have to work out this. Then only I can finalize among that. So 87,75,000 into 30%. 26,32,500. Right, sir? Amount I don't want because I will be putting debt as 30% and equity as 70%. Because anyway, I'm going to find out the weight only. So 12 into 30% will be 3.6%. And 17.82 into 70% will be 12.474. So 3.6 plus 12.474 comes to 16.074. Sir, 16.07. C should be the right answer. Yes, we have matched. Fantastic to the core. 16.07. Comfortable? Now, what is the fifth part? What is the present value of the purchase consideration? Sir, present value of the purchase consideration means they are going to go pay the purchase consideration like this only. Today they will be paying 11,70,000. Its present value will be 1 rupees only. So 11,70,000 is the present value. Sir, this is, we have done it 1. Actually, 1.5 should come now. What is the total PC? 87 lakh. So 87 lakh 75, yeah. 87 lakh 75,000 divided by 5 should comes to 17 lakh 55,000. This you have to discount using our KO. That's what they would have done in the table. Look at here, man. Sir, in the fifth one, 17 lakhs 55, 17 lakh 55, 17 lakh 55, 17 lakh 55, 17 lakh 55. In that first 17 lakh 55, they are paying today. For that, the present value factor they have used at 16.07, which is nothing but KO, what we have finalized now. Using KO, you will be getting the present value factor. Multiply, you will get the present value as 66,58,997. You look at the answer, man. 66,58,997. That's it. This is the way of solving question number 3. That's it with regard to question number 3. Sir, very happy morning to all. So we are doing the case scenario series of the financial management. Already 3 case scenarios we have completed. I'm moving into the 4th case scenario. M Limited is a news broadcasting channel having its broadcasting center in Chennai, like Sun TV, KTV, they are also a channel. There are total 200 employees in the organization, including top management. 200 employees are totally there. As a part of employee benefit expenses, company serves tea to its employee, which is outsourced from a third party. That means for every employee, management is giving tea. The company offers tea 3 times a day. Super, sir. Morning, afternoon, evening. More than they are working, they are drinking tea only. Company offers tea 3 times a day to each of its employees. The third party charges ₹10 for each cup of tea. Company works 200 days in a year. So can we first work out the tea cost? How many employees? 200 employees. Sir, every employee is drinking how many cups of tea? 3 cups of tea every day. Right? For each cup, how much they are paying? That means for 1 day, how much is the tea cost? 6,000 is the tea cost. That means company spending for 1 day 6,000 rupees for drinking tea. How many number of days they are working? So 6,000 into 200 comes to 12 lakhs. Oppa. 12 lakhs is the present cost of the tea. Looking at the substantial amount of expenditure of tea. Okay, fine. Management understood that. They are drinking a lot of tea. The finance department has proposed to the management an installation of the master tea vending machine from Nirmal Limited, which will cost ₹5 lakh with a useful life of how many years? 5 years. The life is how many years? 5 years. Upon purchasing the machine, company will have to incur annual maintenance, which will require a payment of 25,000 every year. This is going to be the new expenses, right? The machine would require electricity consumption of how much units per month? And current incremental cost of electricity for the company is 24 per unit. That means 500 units into 24 comes to 12,000 will be the electricity cost per month. So if you want per year, 12,000 into 12. Right? Apart from this running cost, company will have to incur 8 lakh rupees for consumable like milk, tea, powder, paper cup, sugar, etc. Because if we are manufacturing, we have to incur all these costs. But if we are giving to third party, they will give the tea, everything. They will give it as finished goods tea. The company is in 25% tax bracket. Alright, sir. Straight line method of depreciation is allowed for the purpose of taxation. Nirmal Limited sell 100 master tea vending machine. Variable cost is how much? 4,50,000 per machine. And fixed operating cost is how much lakh? 25 lakh. Capital structure of M Limited and N Limited consists of the following. Equity share capital, face value this much. Reserves and surplus this much. 12% preference share capital this much. 15% debenture this much. Risk-free rate of return 5%. Market return 10%. Beta of the company 1.9. You are required to answer the following 5 questions based upon the above details. Can we? If sales of Nirmal Limited are up by 10%, impact on EBIT is the question. Who is Nirmal? Nirmal is the seller of the tea machine. Seller of the... So I'm going to find out, my dear lovable students, sales minus variable cost calculation, man, for the Nirmal. Sir, sales minus variable cost contribution minus fixed cost is EBIT. Right, sir? My dear lovable students, for one machine, they are going to buy at how much lakh? 5 lakh, which is indirectly given in the question. Because if M Limited is going to buy a machine at 5 lakh, it is a purchasing price of M Limited, which is the selling price of N Limited. Accepting? So for one machine, they are going to sell at 5 lakh. What is the variable cost per machine? 4,50,000. Already given in the question. So 5 lakh minus 4,50,000. 50,000 is the contribution. Accepting, sir? Fixed cost in total only given, but 100 master tea vending machine has been sold by N Limited. So into 100, you will be getting the total contribution. Accepting? So 5 lakh, calculator man, 5 lakh is the selling price per machine into 100. 5 lakh into 100 divided by 1 lakh. Divided by 1 lakh. 500. So 500 lakhs is the total selling price. I am writing in lakhs, man. Otherwise, lot of zeros will come. Are you really with me? The next one. 4,50,000 into 100 divided by 1 lakh. 450. That means 50 lakhs will be the contribution. Now, contribution is total contribution. From that, I can reduce the total fixed cost. Accepting? Total operating fixed cost is how much lakh? 25 lakhs. That means my EBIT will be 25 lakhs. That's it. With this information, I can easily find out the operating leverage. Operating leverage is equal to contribution divided by EBIT. What is the contribution? 50 lakhs divided by. What is the EBIT? 25 lakhs. That means 2 times. What is the interpretation? If 1% change in sales will lead to 2% change in EBIT. They are saying that how much is the percentage change in sales? That means 10 into 2, 20% should be the answer. Sir, for question number 1, D should be the right answer, man. Sir, option D is the right answer, 20%. Accepting? Coming to the next one. Combined leverage of Nirmal Limited. Easy, man. From EBIT, knock off the interest. That's why capital structure has been given in the question. For Nirmal Limited, sir, debenture is 40 lakh. 40 lakhs into how much percent? 15%. Comes to 6 lakhs, which is 40 lakhs into 15%, 6 lakhs. So you will be getting profit before tax comes to 19 lakhs. Less tax at the rate of marginal tax rate has been given in the question. 25%. Sir, 19 lakhs into 25. 4.75 lakhs. Can I proceed? So my PAT, profit after tax, will be 14 lakh 25,000. 14.25. That's it. That is enough for me to find out the combined leverage. So combined leverage is equal to contribution divided by EBT. What is the contribution? 50 lakhs. Divided by what is the EBT? 19 lakhs. So 50 lakhs divided by 19 lakhs comes to 2.63 times. Are you all really with me? What they want the second question, combined leverage 2.63 should be the right answer. Option B, 2.63 should be the right answer. Accepting, sir. Coming to the number 3. Discount rate that can be applied for making investment decision of M Limited. M Limited will analyze their investment decision by using KO of M Limited. The discounting factor of the investing company will be their KO. So they want to find out the KO of what limited? M Limited. Are you really with me? Sir, KO is equal to, I have to find out for the M Limited because it's not one source, they are having multiple sources. Are you really with me? So my dear lovable students, equity share capital is there, reserves and surplus is there, preference share capital is there, debenture is there. Accepting? My dear lovable students, equity share capital 40 lakh, reserves and surplus 25 lakh, preference shares 12 lakh and debentures 20 lakh. Please add it and tell me. 40 plus 25 plus 12 plus 20. 97 lakhs. Now I have to calculate the proportion. Am I right? Sir, 40 divided by 97, 25 divided by 97, 12 divided by 97, 20 divided by 97. Anyway, kacha mucha only going to come. I come like put like this because the total should be 1. Now I have to calculate the KE. KE using the CAPM model. Sir, KE is equal to RF plus beta into RM minus RF. Are you really with me? My risk-free rate is 5% plus beta 1.9 into market return. That means RM given. So 10 minus 5. Premium is 5%. Accepting? So 1.9 into 5, 9.5 plus 5, 14.5% should be the KE. Accepting, sir. Sir, KR should be equal to KE. Again 14.5%. Accepting. Sir, KP 12% is the KP. Accepting, sir. 15 into 1 minus T 0.25. That means 15 into 75%. Accepting, because KD is equal to I into 1 minus T. So 15 into 75% comes to KD is equal to 11. Take the calculator, man. 14.5 into 40 divided by 97 comes to 5.98. Okay, right. 14.5 into 25 divided by 97 comes to 3.73 or rather 74. I'll come your way. Don't worry. 74. Sir, 12 into 12 divided by 97 comes to 1.48. Sir, 11.25 into 20 divided by 97 comes to 2.32. Sir, add it. 5.98 plus 3.74 plus 1.48 plus 2.32 comes to 13.52% should be the KO. 13.52% is the KO. Look at the accuracy. Are you really with me? So for question number 3, sir, right answer should be 13.52%. Are you really with me? I'm coming to question number 4. Incremental cash flow after tax per annum attributable to M Limited due to invest in the machine. Sir, simple. Once they invest in the machine, they will be having savings. What saving? T cost will be the saving. 12 lakh no need to pay. So 12 lakhs will be the savings. But sir, if they are buying the machine, every year they have to pay 25,000 rupees for this expense. This is like an incremental cost. And they have to incur 8 lakh rupees for milk, sugar, salt, etc. etc. This is like an incremental cost. Are you really with me? In addition to that, electricity cost will also be what, man? Incremental cost. So incremental savings is 12 lakh. From 12 lakh, whatever cost they have to incur, minus it. You will be getting the incremental profit before tax. Incremental profit before tax. What is the question? They want after tax. In a sense means from that pay 25% tax. Hello, sir. You will be getting PAT. You have to add back the depreciation. You have to add back you will get the what fat? C fat. This should be the way. Sir, I am, guiding you. Come on, man. Savings in T cost is how much lakh? 12 lakh. That means if I buy the machine, no need to order the T. I can save 12 lakh. Less annual maintenance 25,000. But if I buy the T machine, I have to incur the AMC, annual maintenance cost. How much money will go from my hand? 25. Less cost of electricity, 500 units per month. Sir, every unit 24 rupees. For how much month? 12 month. Already actually we also calculated 1,44,000. Accepting. Less consumable like milk, sugar, salt, etc. How much? 8 lakh. Less depreciation. They themselves question said that you have to calculate depreciation using the straight line basis. Are you really with me? So 5 lakhs divided by 5 years comes to how much? 1 lakh. That means profit before tax is this much. That means if I am shifting the option from ordering tea to manufacturing tea, hello sir, I will be having extra 1,31,000 rupees in my pocket. Will government leave me? They will take 25%. So on this 1,31,000 I have to pay tax of 25%. Balance how much will be there? 98,250 rupees will be there. Sir, this is not the real cash. This is not the CFAT. This is the PAT. As per the capital budgeting chapter, I have to take the decision based upon the depreciation of how much lakh? 1 lakh. So the CFAT will be 1,98,250. There should be option of 1,98,250. For the fourth question, my dear lovable students, 1,98,250 is the right answer. Easy. Coming to the next one. What is the NPV of the investment in the machine by M Limited is the question. What is net present value? Sir, discounted cash inflow minus discounted cash outflow is the NPV, net present value. Can we quickly knock off the NPV also? Nothing, man. Sir, in year number 0, today I have to spend how much lakh? 5 lakh. I have to buy the machine today. So 5 lakh will be cash outflow. Correct? Sir, this is a replacement decision. In the sense means I am going to replace the purchase of the tea into the manufacturing of the tea. For the replacement decision, take the incremental NPV. Incremental CFAT. Already incremental we calculated. How much? 1,98,250. Right? Is there any life of the machine is there? 5 years. Because after 5 years, machine will be swaha. Then again, I have to either purchase a new machine or I have to order from the old vendor itself. That's why for 1 to 5 years, sir, the present value factor 13.52. What is that? KO. We already calculated. Hello, sir. So cumulative present value factor at the rate of 13.52% for 5 years, you will be getting the discounted cash inflow. This is the discounted cash inflow. This is the discounted cash outflow. So you will be getting NPV of 1,88,522. That's it, man. 1,88,522. I believe that's zero difficulty to solve. In this chapter, we have solved leverage analysis. In this chapter, we solved capital budgeting and even cost of capital. Are you all really with me? This is a 10-mark area for examination. Because 5 MCQs into 2 10 mark. I'm solving from the ICAI study material. My dear lovable students, try by your own. You itself will get the answer. If I say, you will understand, you won't think. But if you do, you will think and also you will understand. If you don't think, you need some person behind you or beside you in the examination hall to guide the question. In the coming slot, my dear lovable students, we will be doing case scenario number 5, another a beautiful question and a normal case scenario only, which we have already discussed in the class. Try this case scenario before I try and come back. Sir, very happy morning to all. So we are doing the case scenarios of the financial management, my dear lovable students. We have solved 4 case scenarios. I'm moving into the 5th one, which looks very easy, a small one, which you itself can try and find out. Small bus company is into manufacturing mini buses. Since its establishment, it has seen a phenomenal growth in both its market share and profitability. The financial statement of P&L and balance sheet are shown below. Company enjoy the confidence of its shareholders who have been rewarded with growing dividend year after year. Last year, 2 companies announced 20% dividend, which was the highest in the automobile sector. Company has never defaulted on its loan payment and enjoys a favorable phase with its lenders, which includes financial institution, commercial bank, and other private debenture holders. Competition in the bus industry has increased in the past few years, and company foresees further intensification of competition with the entry of several foreign bus manufacturers, many of whom are market leaders in their respective countries. Minibus segment especially will witness entry of foreign majors in the near future, with the latest technology being offered to Indian customer. Small bus companies management realizes the need for large scale investment in upgradation of technology and improvement of manufacturing facility to beat the competition. That means up to this full rubbish. Nothing required to do the MCQ because they are saying some story. While on one hand, the competition in the industry has been intensifying, on the other hand, there has been a slowdown in the Indian economy, which has not only reduced the demand for buses, but also lead to adoption of price cutting strategy by various bus manufacturers. So till now, nothing is there in the question. Just avoid the data. From here only, the real question starts. Actually, only up to this MCQ is there. The case study information only this. Company needs 3 crore 12 lakh 50,000 for the investment in technology and improvement of the manufacturing facilities. Company has 3 options for the funds. Company may issue 31 lakh 25,000 equity shares of 10 each. As we all know that 31 lakh 25,000 into 10 will get you 3 crore 12 lakh 50,000. Company may issue 15 lakh 62,500 equity shares of rupees 10 each. So 15 lakh 62,500 into 10 comes to 1 crore 56 lakh 25,000. And 1,56,250 debentures of 100 denomination bearing a 9% rate of interest. Again, that will also, sir, 1 crore 56 lakh 25,000 if you, sir, multiply, you will be getting 3 crore 12 lakh 50,000. Are you all with me? That is a second financial plan. Company may issue 15 lakh 62,000 equity shares of 10 each and 1 lakh 56,250 preference shares of 100 per share, bearing a 10% rate of dividend. Company's earnings before interest and tax after investment, it's not before investment, after investment is 37 lakh 50,000. Income tax rate applicable to the company is 40%. That's it. Based on the above facts, management of the company asks you to answer the following question. What is the EPS under financial plan number 1? What is the EPS under financial plan number 2? What is the EPS under financial plan number 3? What is the EBIT EPS indifference point by formula between financial plan number 1 and plan number 2? What is the EBIT EPS indifference point by formula between financial plan number 1 and financial plan number 3? It's a straightforward question. Actually, by doing this question, you can get ready for the descriptive part also. My dear lovable students, basically they are asking the EPS, earnings per share. They are having 3 alternatives, my dear lovable students. We will solve this as if we are doing a descriptive question, because nothing more in this MCQ rather than revising one descriptive part. This is my option 1, option 2 and option 3. Sir, equity share capital. If I am moving with the option number 1, entire 3 crore 12 lakh 50,000 will be raised by the equity share capital. But if I am moving with number 2, sir, 1 crore 56 lakh 25,000. 1 crore 56 lakh 25,000 will be raised through equity. And the second option is debt. Debt means, sir, number 2 is the 9% debt. So 9% debt will not be there in option number 1. Sir, 1 crore 56 lakh 25,000 will be the 9% debt in option number 2. In option number 3, my dear lovable students, 1 crore 56 lakh 25,000 rupees of equity and 10% preference share capital. Instead of debt, 10% preference share capital. Here there is no preference share capital. Here there is no preference share capital. Sir, 1 crore 56 lakh 25,000 will be the preference share capital. This is the total capital employed. That means 3 crore 12 lakh 50,000. Here also 3 crore 12 lakh 50,000. Here also 3 crore 12 lakh 50,000. Are you all really with me? By different forms, that is called as financial plans. In plan number 1, my dear lovable students, number of equity shares. Sir, 100% is going to be what only? Equity only. They themselves said that 31 lakh 25,000 equity shares we are going to issue. Number 2, my dear lovable students, 15 lakh 62,500 equity shares we are going to issue. In third case also, 15 lakh 62,500 equity shares the company is going to issue. Next one, man, debentures. Number of debentures. Actually, in option number 1, there won't be debenture. In option number 2, sir, 1 crore 56 lakh 25,000 is the total debenture value. One debenture face value is going to be 100, they said. So it is 1 lakh 56,250. So 1 lakh 56,250 company will issue as debenture. Sir, here also, sir, debenture will be dash, sir. But number of what shares, man? Preference shares. There is no preference shares in first option and second option. Whereas 1 lakh 56,000, sir, 250 preference shares they will be issuing. This data, sir, I'm just analyzing as if I'm doing a descriptive question, just to revise that part. Sir, company is having 3 options, sir. They can choose any of the option to do the project. Whatever the option they choose, the EBIT, earnings before interest and tax of the company will be 37 lakh 50,000, 37 lakh 50,000, 37 lakh 50,000. Sir, whatever may be the option, I am going to employ only 3 crore 12 lakh 50,000 rupees. Whether I adopted full equity option or equity plus debt option or equity plus preference option, the total employed, capital employed is going to be same. My EBIT will not change. Are you really with me? Less interest. In option number 1, there is no interest at all because it's a all equity option. In second one, out of 1 crore 56 lakh 25,000 into 9% is the interest rate. Sir, how much? 14 lakh 6,250 you will pay as interest. In option number 3, there is no interest because it's a equity plus preference option. You tell man, earnings before tax 37 lakh 50,000 rupees. Sir, 37 lakh 50,000 minus 14 lakh 6,250 comes to 23 lakh 43,750. And 37 lakh 50,000 is the earnings before tax. On this amount, you are supposed to pay the tax. Less tax at the rate of how much percent? 40%. So 37 lakh 50,000 into 40% comes to 15 lakhs will be the tax payable as per option number 1. 23 lakh 43,750 into 40% comes to 9 lakh 37,500 will be the option number 2. 37 lakh 50,000 into 40% comes to 15 lakh is the tax payable under option number 3. So I will be getting PAT, profit after tax. 37 lakh 50 minus 15 lakhs comes to 22 lakh 50,000. 23 lakh 43,750 minus 9 lakh 37,500 comes to 14 lakh 6,250. 37 lakh 50,000 minus 15 lakhs comes to 22 lakh 50,000. Are you really with me? Sir, after PAT, you have to pay the preference dividend. There is no preference dividend in option number 1. There is no preference dividend in option number 2. The preference share capital is 1 crore 56 lakh 25,000. And the rate of preference dividend is 10%. Into 10% comes to 15 lakh 62,500 will be the preference dividend. You will be getting residual earnings. My dear lovable students, 22 lakh 50,000 will be the residual earnings. 14 lakh 6,250 will be the residual earnings. 22 lakh 50 minus 15 lakh 62,500 comes to 6 lakh 87,500 will be the residual earnings. Divided by number of equity shares. Divided by number of equity shares. That's why I calculated the number of equity shares. 31 lakh 25,000 in option number 1. Sir, in option number 2, 15 lakh 62,500. Even in option number 3, 15 lakh 62,500. I will be happily getting the EPS man, earnings per share, 22 lakh 50,000 divided by 31 lakh 25,000 comes to 0.72 per share is the EPS. Number 2, 14 lakh 6,250 divided by 15 lakh 62,500 comes to 0.9 per share is the EPS, earnings per share. 6 lakh 87,500 divided by 15 lakh 62,500 comes to 0.44 per share is the EPS. These are the first 3 MCQ. First one, EPS under financial plan 1, 0.72 should be the right answer. For the first one, sir, option C is the right answer. Are you really with me? Number 2, EPS under financial plan 2, 0.9 per share should be the right answer. Option B should be the right answer. Option B, 0.9 per share. And third one, my dear lovable students, 0.44 per share. Option A should be the right answer. Sir, for the third one, option A is the right answer. What we have achieved by this case study, we have revised the decision of the financial plan. This may be a 5-mark question in the descriptive area. Are you really with me? Now they want indifference point. We have already discussed the financial indifference point. They want between plan 1 and plan 2. What is the indifference point? At indifference point, EPS of plan 1 should be equal to EPS of plan number 2. The most expected question in the descriptive area. So, my dear lovable students, 2 times I have to solve the indifference point, which is financial plan number 1 and financial plan number 2. I am going to do. which is nothing but EBIT minus interest, earnings before interest and tax minus interest. You will be getting EBT, earnings before tax. From that, you have to pay tax at the rate of 40%. You will be getting PAT, profit after tax. Minus preference dividend, you will be getting residual earnings. Divided by number of equity shares, you should get the what? EPS, earnings per share. The EPS of the financial plan number 1 should be equal to EPS of the financial plan number 2. That is called as indifference point. At indifference point, EPS will be same. At break-even point, there is no profit, no loss, the same way. My dear lovable students, there is a level of EBIT, whether it is for plan number 1 or plan number 2, the EPS will be same. I don't know what is the EBIT. I will assume it as E. E stands for EBIT. In option number 1, there is no what at all, interest at all, because it's a all equity option. Whereas in option number 2, we are going to pay an interest of 14,06,250. So 14,06,250. Are you agree with me? My dear lovable students, so earnings before tax is what it only? EBIT only. Here it is EBIT minus 14,06,250. Sir, 0.4E I should pay as tax, because from 1E, 40% means 0.4E. So 0.6E will be the PAT, profit after tax. My dear lovable students, here 0.4E minus, take your calculator, 14,06,250 into 0.4 comes to 5,62,500 will be the tax you will be paying. So automatically, sir, 1E minus 0.4E, you will get 0.6E minus 14,06,250 minus 5,62,500 comes to 8,43,750 will be the profit after tax. On that profit after tax, in financial plan number 1, I don't have preference shares at all. Even in financial plan number 2, I don't have preference shares at all. So 0.6E and 0.6E minus 8,43,750 is the profit after tax. Number of equity share, in situation number 1, 31,25,000 is the number of equity shares. Are you all with me? In situation number 2, sir, 15,62,500 is the number of equity shares. That means my EPS should be same. What is my EPS? Sir, residual earnings divided by number of equity shares. So 0.6E divided by 31,25,000 should be equal to 0.6E minus 8,43,750 divided by 15,62,500. Are you with me? At indifference point, what is indifference point? Financial indifference point. In costing, we will learn the cost indifference point, which is nothing but difference in fixed cost divided by difference in variable cost. Hello, sir. Here it is a level of EBIT where my EPS under both the options will be one and the same. So 0.6E divided by 31,25,000 should be equal to 0.6E minus 8,43,750 divided by 15,62,500. Here also 2 zeros I am cutting. Here also 2 zeros I am cutting for the purpose of easy cross multiplication. Hello, sir. So 0.6E divided by, instead of become 31,25,000, it will become 31,250. Am I right, sir? Should be equal to 0.6E minus 8,43,750 divided by, sir, instead of 15,62,500, it will become 15,625. Now I am going to cross multiply. 15,625 into 0.6 comes to 9,375E should be equal to, I just cross multiplied this, sir, 31,250 into 0.6 comes to 18,750E minus 31,250 into 8,43,750 comes to 26367187,500. Are you all with me? I can, sir, minus it. 18,750E minus 9,375E should be equal to same 26367187,500. If you don't want that number, you just keep it as 31,250 into 843,750. Are you all with me? So 18,750 minus 9375 comes to 9375E is equal to 31,250 into 8,43,750. This is the number you are getting. Are you all with me? So E is equal to 31,250 into 8,43,750 divided by 9375. So 31,250 into 8,43,750 divided by 9375 comes to 28,12,500 is the E. My dear lovable students, 28,12,500. I am replacing the answer 28,12,500. 28,12,500. It will be dash here. It will be 14,06,250. Am I right? So 28,12,500 will be the EBT. Here 28,12,500 minus 14,06,250 comes to 14,06,250. On this 60% will be the PAT. 28,12,500 into 60% comes to 16,87,500 will be the profit after tax. Here 14,06,250 into 60% comes to 8,43,750 is the PAT. There is no preference dividend. So 16,87,500 and 8,43,750. 16,87,500 divided by 31,25,000 comes to 0.54 is the EPS. Are you with me? 8,43,750 divided by 15,62,500. There also 0.54. That's what the indifference point is all about. So if the company is having an EBIT of 28,12,500, their 28,12,500, their EPS between financial plan number 1 and financial plan number 2 will be same. This is the most expected area at the descriptive. So option A should be the right answer for the fourth one. So that's what option A, 28,12,500. What I have done in my technique, they have done by using the formula. The same thing. I put the table. They have done with this formula itself. Nothing. EBIT. Even I also start with E only. Right? Minus what man? Interest. That's what? Into 1 minus tax. Sir, in first situation, there is no interest at all. That's why they have not reduced the interest. But in second one, financial plan 2, we are having interest. That's what EBIT, what? Minus interest. Accepting. Sir, tax is there, 1 minus T and 1 minus T. This is a number of equity share in financial plan number 1. Number of equity share in financial plan number 2. They just cross multiplied. What we have done, they got the answer. Sir, if you want to have a beautiful grip once again, they are having one more question. Don't worry at all. We'll be trying EPS, EBIT analysis of plan number 1 and plan number 3. Sir, will you help me to do the same man? Plan number 1 and plan number 3. What I have to do, I have to put a column like this. This is financial plan number 1 and financial plan number 3. Right, sir? My dear lovable students, earnings before interest and tax, EBIT, minus what? Interest. Earnings before tax, less tax at the rate of 40%. You will be getting the PAT, profit after tax, minus preference dividend. You will be getting residuary earnings divided by number of equity shares. You will be getting the EPS, earnings per share. That's it. EBIT, I don't know. EBIT, I don't know, because that's what the answer itself. It's a level of EBIT where my EPS under financial plan number 1 and financial plan number 3 will be one and the same. Interest in financial plan number 1, I don't have interest because it's a all equity company. Even under financial plan number 3, I don't have interest because it's equity plus preference option. Are you all with me? So my EBT will be E and EBT will be E. 0.4E I will pay as tax. 0.4E I will pay as tax. That means 0.6E will be my PAT. Divided by preference dividend. There is no preference dividend under option number 1. But in option number 2, I have to pay, sir, how much rupees as preference dividend? 15,62,500. Sir, 15,62,500 I have to pay as preference dividend. So my residual earnings will be 0.6E. Here 0.6E minus 15,62,500. Under option number 1, I'm having how much number of equity share? 31,25,000 number of equity shares I'm having. But under option number 3, sir, I'm having number of equity share 15,62,500. Right, sir? That's what? 15,62,500. Right, sir? So, my dear lovable students, sir, is the preference dividend correct? No? 15,62,500. Alright, sir. So, 0.6E divided by 31,25,000 should be equal to 0.6E minus 15,62,500 divided by, sir, 15,62,500. Sir, in my indifference point, EPS should be one and the same. So, 0.6E divided by 31,25,000 should be equal to 0.6E minus 15,62,500 divided by 15,62,500. Can I remove the two zeros, man? So tell me, 0.6E divided by 31,250 should be equal to 0.6E minus 15,62,500 divided by 15,625. Can I cross multiply? 15,625 into 0.6 comes to 9,375E should be equal to 31,250 into 0.6 comes to 18,750E minus 31,250 into 15,62,500, because I'll be getting a very long answer. Are you all with me? So basically 18,750E minus 9,375E should be equal to 31,250 into 15,62,500. Accepting? 18,750 minus 9,375 comes to 9,375E should be equal to 31,250 into 15,62,500. Accepting? So E should be equal to 31,250 into 15,62,500 divided by 9,375. So 31,250 into 15,62,500 divided by 9,375 comes to 52,08,333 should be the what, man? EBIT. We are having 52,08,333.33. For the last one, option D should be the right answer. Brilliant way of solving the question. Are you all really with me? Sir, actually, to solve this question, I have taken 25 minutes of time because I have done same like I am doing a descriptive question. If the same question has been, sir, shooted for examination, this will be a 10-mark question. Because 5 MCQ, each MCQ carrying 2 marks. The standard time to solve, sir, 1 mark is 1.8 minutes, as we all know. So, sir, 10 into 1.8 means 18 minutes are allowed. That means if you are solving the same question like a descriptive, my dear lovable students, still you can complete within 20 minutes of time. Why I am saying this means, sir, in order to solve an MCQ, why this much working? No, this is asked as an MCQ, but descriptive question only. So when you are solving that in examination, don't get tensed. For a 10-mark MCQ, you can spend up to how much minutes of time? 20 minutes of time. So aram se, happily you solve. You will be getting the answers. First of all, this is a beautiful question which will be able to revise the, sir, financial plan and also the financial indifference point. Are you all really with me? With this, sir, case study number 5 also comes to an. We have to move into case study number 6. Before that, you settle, do case study number 5, try case study number 6 and come back, my dear lovable students. We'll be together doing case study number 6. I'm with you, sir, from your heart. Anybody is there? Where is a grand clap? Yes, sir. I hope that you would have very comfortable with the case scenario number 5 and we are moving into case scenario number 6. Case scenario number 6 is a very normal case scenario which will help us to revise the chapter cost of capital, my dear lovable students. MNP Limited is a multinational company having its operations spread mostly in India and neighboring countries of India. The promoters of the company believed that capital structure of the company must be kept flexible and balanced, where proper mix should always be maintained between debt and equity. That means this company is not believing all equity. This company wants a mix of debt and equity. Such mix of debt and equity should be reviewed from time to time, keeping in mind the changing situation of India and the global scenario. That means whenever required, they want to change the debt and equity proportion. Capital structure of MNP Limited, that means the real question is starting from here only. 9% debentures of 2,75,000. This is the book value weight. So the KD is 9% before tax. 11% preference shares of 2,25,000. KP is 11% and book value weight is 2,25,000. Equity shares face value 10 per share. Book value is totally 5 lakh. Total capital of the company is 10 lakh, which is nothing but 2,75,000 plus 2,25,000 will get you 5 lakh. Plus another 5 lakh will give you 10 lakh. Following are some of the additional information provided by MNP Limited related to the above mentioned capital structure. For that 10 lakh, market value details has been given. Rupees 100 per debenture is redeemable at par. That means debentures are redeemable debentures. Has 2% flotation cost. That means if you are issuing today 2 rupees, 100 rupees debenture, 2 rupees will be the flotation cost. And 10 years of maturity, that means life is equal to 10 years. Market price per debenture is 105. If nothing has been given in the question, we have to take the market price as the issue price. From that issue price, because if you are today issuing a debenture, the company will be able to enjoy 105. From that 105, we have to reduce the 2% flotation cost. Rupees 100 per preference share redeemable at par has 3% flotation cost and the same 10 years of maturity. Market price per preference shares is 1062. So today the current market price is 106. Equity share has rupees 4 flotation cost and market price is 24. That means 24 minus 4, 20 rupees will be the net proceeds. Next year expected dividend is 2 per share. That means DPS 1. Because it's not the dividend what you already paid. It is a dividend next year expected with an annual growth rate of 5%. G also directly given in the question. Firm has practice of paying all earnings in the form of dividend. That means it's 100% payout ratio. Corporate income tax rate is 35%. Since a company is a multinational company, market value weight are preferred over book value weight when calculating the weighted average cost of capital for several reasons. We know that we are having two options to calculate the WACC, either book value weight or the market value weight. Book value weight is like historical cost. Market value weight is like fair value cost. That means today's WACC can be found out by using the market value weight. Company believes that market value will reflect the current market perception of company's financial health and future prospects. All unnecessary story. This is more relevant for calculating the cost of capital today as investors base their decision on current market condition. Book value based on historical accounting principle may not accurately represent the true economic value of the company's capital components. All rubbish data they have given. Market value capture the actual cost that the company would incur if it were to raise new capital in the what market? Current market. Again, theory, unnecessary things. Book value weight might not reflect the true cost of debt due to factors like change in interest rate, credit worthiness, etc. Similarly, book value of the equity might not reflect the current investor expectation for future dividend and growth. Market value are readily available through stock prices and market interest rate. Obtaining accurate book value, especially for intangible asset, can be complex and time-consuming process. This data, you can absolutely ignore it because put it on dustbin. That's it. Yes, man. I'm start reading. On the basis of this information provided above, you are required to answer the following MCQ from 1 to 5. Calculate the cost of equity and choose the correct answer from the following. That means they won the KE. KE is equal to DPS 1 divided by MPS 0 plus G. Actually, they themselves given the DPS 1, my dear lovable students. The expected, next year expected dividend is 2 per share. It's already a grown dividend. No need to apply the growth rate, right? So 2 divided. MPS 0 means 20 because the current market price is 24. But if we issue 1 share, 4 rupees will go as flotation cost plus growth rate of 5%. So 2 divided by 20 means 10% plus 5% means 15% should be the KE. That's what option number B, 15%. Are you really with me? It's a normal revision question from the cost of capital only, normal question. Calculate the cost of debt and choose the correct answer from the following. They don't want the accurate answer. So we are not going to solve using YTM. We are going to use the approximation method. Since the debt is a redeemable debt, KD is equal to I into 1 minus T plus RV minus NP divided by N whole divided by RV plus NP divided by 2 into 100. We have to just put the data here. I means interest, my dear lovable students. What is the face value of the debt? Face value of the debt is 100. For that 100, because below they have given that 100 per debenture. Right, sir. Sir, 100 into how much percent? 9%. So 100 into 9% comes to 9 rupees is the interest. So 9 into 1 minus T, what is the corporate tax rate they have given in the question? How much percentage? 35% is the corporate tax rate. So come on, we are going to apply it. What is the interest? 9 into 1 minus 0.35 plus what is the redemption value given in the question? They specifically said that redeemed at par. What is the par? 100 rupees. So 100 minus net proceeds. Net proceeds, nothing, since it has not been given anything in the question. Current market price minus flotation cost. What is the current market price? 105. 2% is the flotation cost. So 105 into 98% will be the net proceeds. 102.9. Net proceeds 102.9 divided by life is 10 years. Whole divided by redemption value is 100 plus 102.9 divided by 2. Basically, sir, today we are getting 102.9. But in future, we are going to repay only 100. So actually, it's a capital profit and not a capital loss. So instead of plus, I have to do here minus. So 9 into 65%. How much 9 into 65? 5.85 minus, sir, 100 minus 102.9 means 2.9. It has to be amortized over a period of 10 years. 0.29 divided by average liability of 100 plus 102.9 divided by 2 comes to 101.45 into 100 is the KD. So 5.85 minus 0.29 comes to 5.56 divided by 101.45 into 100. 101.45 into 100 comes to 5.48%. Should be the right answer. 5.48% is the KD. It's a very basic revision question. Calculate the cost of preference shares and choose the correct answer from the following. KP, even KP is also redeemable. So my dear lovable students, KP is equal to PD plus RV minus NP divided by N whole divided by RV plus NP divided by 2 into 100. Preference dividend, you have to apply the preference dividend on the face value. Face value is 100 rupees. 100 into 11% comes to 11 rupees is the preference dividend. Even preference shares also has to be redeemable at par. Par is 100 rupees, man. So 100 rupees is the redemption value. Minus net proceeds. Today, the current market price is 106. On that flotation cost is 3%. So 106 into 97% will be the net proceeds. How much? 102.82. Divided by same life of 10 years. Divided by 100 plus 102.82. Divided by 2 into 100, my dear lovable students. So 11, it's not plus, it's minus. Why? Because today I'm getting 102.82, but I'm supposed to repay only 100. So 102.82 minus 100 comes to 2.82. That has to be amortized over a period of, so 0.282 divided by average liability of 100 plus 102.82 divided by 2 comes to 101.41 into 100. So basically net cost of 11 minus 0.282, 10.718 divided by 101.41 into 100 divided by 101.41 into 100 comes to 10.57%. Should be the KP, that's what, 10.57%. Option A should be the right answer for the third question. 10.57%. Again saying, just a very normal question for revising the cost of capital. Calculate the WACC using the market value weight and choose the correct answer from the following. We know how to put the WACC table, my dear lovable students. First, you have to put the source. Debenture is there, preference shares is there, equity shares is there. Actually, debenture, they have given the total book value of the debenture, right, sir? How much is the book value? 2,75,000. What is the face value per debenture? 100. Calculator. 2,75,000 divided by 100. 2,750 debentures they are having. 2,25,000 preference shares they are having. Divided by 100. How much? 2,250 preference shares they are having. 5 lakhs divided by 10 comes to 50,000 equity shares they are having. Nothing. This number of instrument into market value per instrument will the market value weight. There you should not reduce the flotation cost. Are you already with me? So debenture, how much number of debentures you got? 2,750 into 105. Please feel the figure. How much? 2,88,750. Are you getting this answer? Preference shares. How much preference share? 2250 into 106 comes to 2,38,500. How much number of equity share? 50,000 equity share into 24 comes to 12 lakhs. Total comes to 17,27,250 is the total capital employed as per the market value weight. Now we have to find out the weight, which is nothing but 2,88,750 divided by 17,27,250. 2,38,500 divided by 17,27,250. 12 lakhs divided by 17,27,250. Right, sir? This is the weight. We already just now calculated what is the individual cost of capital. KD 5.48%, KP 10.57%, and KE 15%. Just you have to take the calculator. We know 5.48 into, sir, 16.72% comes to, sir, 0.92%. Are you really with me? Sir, the next one, 10.57 into 13.81% comes to 1.46%. 15 into 0.6947% comes to 10.42. Basically, 12.80 is the WACC. So the option KO is 12.8. Option number A should be the right answer. A very, very basic question, my dear lovable students. 12.8 is the KO. The last one. What will be the current market price of MNP Limited equity share? That means they want the MPS 0. If KE is 10%, they themselves given the KE. So we know that KE is equal to DPS 1 divided by MPS 0 plus G. So they want the MPS 0. So this plus G I can drag here as minus G. So KE minus G is equal to DPS 1 divided by MPS 0. And expected dividend has been given as 2 per share. That means expected dividend means DPS 1. And annual growth rate 5% from the following option is the question. So my dear lovable students, sir, what is the KE? What is the KE? 10%. So 10% minus growth rate of 5% should be equal to DPS 1 is 2 divided by MPS 0. I can easily put the cross multiplication. So 5% is equal to 2 divided by MPS 0. Alright, sir. That means, sir, MPS 0 is equal to, yes, MPS 0 is equal to 2 divided by 5% comes to 40 rupees is the answer. So for fifth answer, man, A part should be the right answer, 40 rupees per share. I just, sir, reverse the working. So this is a very relaxing question from the cost of capital, my dear lovable students. If you try by yourself itself, you'll be getting the answer. If you are having any doubt, you just go through this. That's it with regard to our case study number 6. And just take a break of 5 minutes time. Read case study number 6 and read case study number 7. A very good question. We'll be start solving case study number 7. Yes, sir. I believe that you are very comfortable with the case scenario number 6 and I'm moving into case scenario number 7. A very good case scenario from the working capital management. Generally, people will avoid that chapter. Sir, it's a 10-mark area for examination. If you have prepared the chapter working capital management, according to me, this is a very good question to revise the working capital management. Fine. Sir, AR More LLP is newly established. We all know that in working capital management, that word is having a big importance because newly established means opening stock is equal to 0. So when you are estimating the working capital, we have to estimate for the current year plus also for the closing, that is the stock. Startup dealing in manufacture of revolutionary product HDHMR, some product name has been given, which is substitute to conventional wood and plywood. Right. They are going to manufacture some product. It is economical substitute for manufacture of furniture and home furnishing. It has been asking by venture capitalists for estimated amount of fund required for set up the plant and also the amount of circulating capital required. Set up the plant is called as capital budgeting. Circulating capital is called as working capital, right? Consultant hired by NDT has advised that cost of setting up the plant would be how much crore? 5 crore. and it would require 1 year to make the plant operational. That means the total amount required to set up the plant is 5 crore. Capital budgeting is 5 crore. Anticipated revenue and associated cost numbers are as follows. Unit to be sold 3 lakh square meter per annum. Like liter, like kilogram, they are expressing in square meter. How much square meter? 3 lakh square meter has to be sold. That means we have to produce 3 lakh square meter plus we have to produce the closing stock also. Sale price of each square meter is how much? 1000. So 3 lakh into 1000 comes to 3000 lakhs is the selling price. Raw material cost for every square meter it is 200. Labor cost every square meter for per hour is 50. And labor hours per square meter is 3. Basically 3 into 50, 150 rupees is the labor cost per square meter. Cash manufacturing overhead, that means they have not given the depreciation. It's a cash cost approach, 75 per machine hour, and machine hour per square meter is 2 hours. So 75 into 2 comes to 150 rupees square meter. Selling and credit administration overhead is 250 per square meter. They themselves has been directly given in the question. Being a new product in the industry, firm will have to give a longer credit period of 3 months to the customer. That means debtors is 3 months. It will maintain a stock of raw material equal to 15% of the annual consumption. So first we have to find out what is the annual consumption, raw material consumed. Into 15% will be the raw material stock. This raw material consumption plus raw material stock has to be purchased from the creditor. Based on negotiation with the creditor, payment period has been agreed to be how much month? 1 month. That means debtors is going to be 3 months and raw material is going to be 15% and creditors is going to be 1 month from the date of purchase. Entity would hold finished goods equal to 2 months units to be sold. We know that how much units they are selling, 2 months to be kept it as finished goods. All other expenses are to be paid 1 month in arrear. That means there is a lag of 1 month. Cash and bank balance to the tune of 25 lakhs is required to be maintained, which is directly given in the question. Entity is also considering reducing the working capital requirement by either of the following 2 options. Reducing the credit period to customer by a month, which will lead to reduction in sales price by 5%. That means currently the debtors collection period is equal to 3 months. They want to reduce the debtors collection period to 2 months because they are going to reduce by 1 month. Once they do like that, sales will reduce by 5%. Number 2, option number 2. Engage with a factor. We have already discussed factoring in case scenario number 1. For managing the receivable, who will charge a commission of 2% of the invoice value and also advance 65% of the receivable at 12% per annum. In this question, they themselves given what is the amount of advance the factory is going to be given. It is 65%. For that 65%, my dear lovable students, they will be charging an interest of 12% per annum. This will lead to savings in administration and bad debt costs to the extent of 20 lakh and 16 lakh respectively. So we can save 20 lakhs and 16 lakh. The entity is also considering funding a part of working capital by what loan? Bank loan. For this purpose, bank has stipulated that it can grant 75% of the net current asset, basically maximum permissible bank finance topic they are testing, as against advance against the working capital. Bank quoted 16.5% rate of interest with a condition of opening a current account with it, which will require 10% of the loan amount to be minimum average balance. You being the finance manager has been asked the following question. Anticipated profit before tax per annum after the plant is operational, which is nothing but they want the profit, budgeted profit before tax, which is nothing. We are having number of units we are going to be sell into selling price per unit will give you the total sales minus all the costs they have given like direct material, direct labor, direct expenses, everything. If you reduce all the costs, you will get the profit. The estimated current asset requirement in the first year of operation, data should be calculated. Cost, they are saying, don't calculate the data at the selling price. Right, sir. That means we know that working capital estimate is equal to current asset minus current liabilities. Net working capital requirement, that means they have not asked current liability as a specific MCQ. Sir, current asset minus current liability is equal to working capital. In the second MCQ, they asked the current asset. In the third MCQ, they are asking working capital. So automatically, we are supposed to calculate the current liabilities. The annualized percentage as cost of two option for reducing the working capital. Sir, we can either reduce the cost of the data's collection period from 3 months to 2 months. If that is the case, what is the annualized cost? Or we can hand over our debtors to the factors, then also what is the annualized cost? What will be the maximum permissible bank finance by bank, annualized percentage of the same? How much bank will maximum give to us? And also what is the rate is what the question, according to me. It's a very good question for revising the chapter working capital management. Actually, if you see, 3 layers are there in the MCQ. One is full and full is working capital management. Number 2, they are asking factoring. Third, they are asking maximum permissible bank finance. 3 concepts has been tested in 1 MCQ, 1 case study, my dear lovable students. We'll be starting one by one. Look at the question and be with me. We are going to find out the anticipated profit, my dear lovable students. First of all, sir, this is the per unit. Raw material consumption. Raw material consumption per unit has been given. For 1 unit of finished goods, what is the raw material? 200 rupees is the raw material. It is directly given in the question. Look at, man, raw material cost is 200 per square meter. Right, sir. The next one, man, labor cost. For 1 hour, we have to pay 50 rupees. For 1 square meter, we have to spend how much hour? 3 hour. Are you all really with me? So 50 into 3 comes to 150. That's what this 150 is all about. That's what the labor cost. Then production overhead. Nothing. I'm just preparing the cost sheet. Production overhead is, sir, manufacturing overhead. 75 per machine hour. For 1 square meter, 2 hours you have to take. So 75 into 2 comes to 150. That's it, man. 200, 150, 150. Sir, 500 rupees is the cost of production. That means in order to produce 1 square meter, 500 rupees I have to spend. They have given the selling price per unit, man. Sales price is how much per square meter? 1000 per square meter. That means selling, this is the cost. Sir, selling price is equal to 1000. So selling price is 1000. Hello, sir. And the cost of production is 500. That means my gross profit is 500. In addition to that, I have to incur the selling and credit administration, 250 per square meter. So from this 500, reduce the 250. So 250 will be my net profit. So 250 into how much square meter you are selling? 3 lakh square meter. So 250 into 3 lakhs comes to 7 crore 50 lakhs. Basically 750 lakhs should be the profit. The first question, more or less like a costing question only. 750 lakhs is the profit. That's what option A they are getting. Option A is 750 lakhs. Right, sir? 750 lakhs is the answer. Fine. Sir, what they have done? They have not done anything. They have done the cost sheet. Nothing, man. Raw material consumption. They have calculated full. Because in the question, anyway, we have to estimate the working capital. Sir, how many units you have to sell? 3 lakh units you have to sell. For, sir, every finished goods, how much raw material is needed? For 1 unit of output, 1 square meter of raw material is needed. Right, sir? So 3 lakh is what you are going to sell. That means you are going to produce 3 lakh units of finished goods. My dear lovable students, they specifically said that raw material stock will be equal to 15% of the what consumption? Annual consumption. That means you are going to consume how much raw material? 3 lakh raw material, because you are going to manufacture 3 lakh units. So 3 lakh, sir, is the raw material you need for production. You need for production. And you have to keep the finished goods also. You have to keep the finished goods also. So I will be doing production for the units to be sold and for the closing stock. Right, sir? How much units you are going to sell? 3 lakh square meter you are going to sell. What is the stock of the finished goods? Not the raw material. What is the stock of the finished goods? Sir, how much finished goods? The NDT will hold finished goods equal to how much months unit? 2 months unit. That means closing stock will be 3 lakh into 2 by 12 comes to 50,000. That means 3 lakh plus 50,000. 3 lakh 50,000 will be the raw material consumption. That's what they have done into 200. This is nothing, man. Basically the cost sheet. Raw material consumed. Add direct labor. Sir, I have to spend the direct labor both for the units which I am going to sell and also for the finished goods which I am going to keep as stock. So, labor, man, the same. How much units you are going to sell? 3 lakh. So 3 lakh plus how much units you are going to sell? How much units you are going to sell? 3 lakh into 2 months, sir, closing stock I should give. So 3 lakh into 2 by 12, same 3 lakh 50,000 will be coming, right, sir? The same explanation will be applicable for production overhead. So cost of production will be for 3 lakh 50,000. 500 rupees is the cost of production per unit. Less closing stock of finished goods, 50,000 units, man, at the rate of 500. So cost of goods sold is only 3 lakh at the rate of 500. Add selling and administration expenses that we will be incurring only for the cost of goods sold, which is for 3 lakh units at the rate of 250. So the cost of sales is 3 lakh. The total cost comes to 750. This 3 lakh square meter we are going to sell at 1,000 rupees. So 1,000 minus 750, 250 rupees is the profit. 250 into 3 lakh is what? 750 lakhs. The first part of the answer we have done. Coming to the second one. Estimated current asset requirement in the first year. Sir, current asset means what and all will come as current asset, man? Raw material stock will come, WIP stock will come, finished goods stock will come, debtors will come, cash will come. Cash already given in the question. As how much lakh? What is the cash requirement? 25 lakhs. Straight away they have given, man. So we are going to work out, man. Cash is 25 lakhs. Straight away given. So we have to, sir, estimate the raw material, finished goods and debtors, because WIP details has not been given in the question. Raw material stock, whatever you are going to consume, 15% of that consumption should be kept as raw material stock. For that purpose only, question has prepared the cost sheet. What is the cost of raw material consumed? 7 crores, my dear lovable students. 7 crores into 15% comes to 1 crore 5 lakh should be the budgeted amount for the raw material. Are you already with me? There is no WIP. Coming to the finished goods. Sir, finished goods, how many units finished goods? 50,000 units. 50,000 into, my dear lovable students, already we have valued the finished goods in the cost sheet. Stock of finished goods is 2 crore and how much lakh? 50 lakhs. This is the stock of what goods? Finished goods. For how much months? 3 months, sir, 2 crore 50 lakhs. Coming to debtors, man, they specifically said that debtors should be valued at the cost, right, sir? What is the cost of, sir, total cost of goods sold? 15 crores is the cost of goods sold, right, sir? Sir, this is only, sir, cost excluding selling and administration. I have to add the selling and administration, then only the goods will reach the customer. So 22 crore 50 lakhs is the cost of sales. I am not going to add the profit when I am valuing the debtors. So 22 crore 50 lakhs into 3 months sales should be treated as the debtors. So 5 crore 62 lakh 50,000. Cash already given in the. So total current asset is 9 crore 42 lakh 50,000. That's the answer, man, for the second one. 9 crore 42 lakh 50,000 for the second question. Now from the current asset, if I reduce the current liability, which is 9 crore 42 lakh 50,000 minus current liability, I will get the net working capital. Current liability is nothing. Sir, I'm having only one expenses given in the question. What is that expense? Selling and distribution, selling and credit administration overhead, 250 per square meter, man. That for that I have to calculate. Come on, man. Sir, same 9 crore 42 lakh 50,000. I'm continuing. Basically, no need to write once again. Already current asset we have done. Minus creditors and outstanding expenses we have to less. Creditors is not for the raw material consumed. It is for the raw material purchased. Right, sir? Raw material consumed is, how much is the raw material consumed? Raw material consumed is 7 crore, right, sir? So raw material consumed is equal to 7 crore, right, sir? And, sir, I need raw material as closing stock also. What is the stock of raw material I should keep? 1 crore 5 lakh rupees. Already we have estimated when we estimate the working capital, right, sir? So 7 crore of raw material I need for consumption. 1.5 crores of raw material I should be keep as stock in the stores. That means totally 8 crore 5 lakh of raw material I should purchase from the creditor. So 8 crore 5 lakh into 1 by 12, because they are giving 1 month credit period. Sir, 67 lakh 8,333 will be the credit allowed by the creditors. Outstanding expenses, my dear lovable students. Sir, what is the expenses given in the question? Selling and administration. 250 per square meter. 250 into 3 lakh, because that you will be incurring only for the number of units sold. So how much, man? 7 crore 50 lakhs. That is total 3 lakhs is the square meter into 3 lakhs into selling and distribution is 250. 7 crore 50 lakhs is the total you are incurring. Yes, sir. 7 crore 50 lakhs into what by 12? 1 by 12. Is there any other expense? Like wages are also there. Wages are also there. Yeah? Read the question. Labor cost is also there. Is there any other expenses are there? What they have said? Cash and bank balance 25 lakhs given. Now, all other expense are to be paid 1 month in arrear. That means all other expense means except material, because material will be covered by creditors. Now labor I have to take, man, and cash manufacturing overhead I have to take. Selling and administration also I have to take, because all are cash expenses, man. So go to the cost sheet, man. What is the labor cost in the cost sheet? 5 crore 25 lakhs is the labor cost, right, sir? So 5 crore 25 lakhs plus the production overhead of 5 crore 25 lakhs. So 525 plus 525 comes to 10 crore 50 lakhs plus selling and administration of 7 crore 50 lakhs, right, sir? Comes to 18 crores. That's why 18 crores into 1 by 12. If you want, you take, sir, labor separately. If you want, you take selling and administration separately. If you want, you take manufacturing overhead separately. Or like that also you can put, since all the outstanding expenses are 1 month in delay, in common. So 18 crores into 1 by 12 comes to 1 crore 50 lakhs. That means this is the liability, man. So from the current asset, if you reduce the liability, your total, sir, working capital will be 7 crore 25 lakh 41,667. 7 crore 25 lakh 41,667. Question number 3 should be, option number C should be the right answer for the question number 3. A very beautiful question, man. Percentage of cost of 2 option for reducing the working capital. What are the 2 options available? Sir, instead of giving 3 months collection period to the debtors, give 2 months. Then what will be the impact for that? Automatically sales will reduce by 5%. That means, according to me, this is a beautiful line of interpretation from ICAI, because the reason is the new debtors credit period is going to be 2 months, right? That means, what is the present debtors balance, my dear lovable students? Currently, the debtors are having a balance of 5 crore 62 lakh 50,000. We already analyzed. This 5 crore 62 lakh 50,000 is for how much months? 3 months. Are you all with me? This 5 crore 62 lakh 50,000 is for 3 months. So this is the 3 months debtor. This we are going to revise to how much months, man? 2 months. 2 months. That means debtors is going to less. Debtors is going to less. If debtors is less means that much current asset is not required. That means current asset will release. That much amount no need to block in the what asset, man? Current asset. That's what they are calculating. New debtor balance they have calculated. New debtor balance they have calculated. Right, sir? How many units you thought of selling to the customer? 3 lakh. So number of units sold is going to be 3 lakh. Right, sir? 3 lakh. My dear lovable students, sir, into there is going to be a reduction of 5%. So into 95% will be the new debtor for the annual. Comes to 2,85,000 is the units. That's what they have used, 2,85,000. Sir, every unit, what is the cost of sales? 750. So 2,85,000 into 750 comes to 21 crore 37 lakh 50,000 is going to be the total debtors for the entire 12 months. But the credit period is going to be for 2 months. That's why into 2 divided by 12 comes to 3 crore 56 lakh 25,000. That means earlier it was for how much period? 3 months. We already calculated the debtors balance earlier, 5 crore 62 lakh 50,000. So earlier, as working capital, we are supposed to invest 5 crore 62 lakh 50,000. So 5 crore 62 lakh 50,000 minus 3 crore 56 lakh 25,000. What is the difference? Delta. 2 crore 6 lakh 25,000 will be released. Are you all really with me? This much amount of working capital, no need to invest. Right, sir? Sir, If debtors reduced, automatically sales reduced. If sales reduced, profit reduced. Sir, selling price per unit is equal to how much? 1000. And the cost of sales is how much? 750. And my net profit is equal to 250. That means I will lose 250 per unit for 15,000 unit. How, sir, 15,000? Because earlier sales unit is equal to 3 lakh. I am losing 5% of 3 lakh, sir, which comes to 15,000. That means I will lose a profit of 250 rupees. 37 lakh 50,000 rupees profit will reduce, right? Sir, how much rupees of profit I will lose? 37 lakh 50,000. This, for losing 37 lakh 50,000, I no need to invest 2 crore 6 lakh 25,000 into 100 comes to 18.18% should be the right answer. Option A. 18.18. B is not matching. Right, sir? C is not matching. D is not matching. I can say that option A is the right answer. But I have to confirm the second one also. 16.92%. Now I have to work for the factoring. That's what I'm going to do, man. Sir, factoring. Sir, cost of factoring I'm going to calculate. My dear lovable students, what is the debtors collection total 30 crores. My dear lovable students, what is the total debtors is going to be? 3 lakhs into, what is the selling price? Selling price 1000. So 3 lakhs into 1000 comes to what is the total credit sales for 1 year? 30 crores. 30 crores. Sir, of that 30 crores, I'm going to calculate annually straight away. This 30 crores, how it came? How much units you are going to sell? 3 lakhs at a selling price of 1000. So 30 crores into 2% will be the commission. 60 lakhs they will charge as commission. And they are going to advance a 65%, which is straight away given in the question. For that, they will be charging interest at the rate of 12%. And original debtors collection period is 3 months and it is not 2 months. Right, sir? So 30 crore into 65% into 12% into 3 by 12 comes to 58 lakh 50,000 rupees. They will collect as what also? Interest also. This is the cost we are supposed to incur. Then savings will be there, my dear lovable students. Sir, we are not supposed to incur the admin cost of how much lakh? 36 lakhs. So, my dear lovable students, we can save 36 lakhs. But 60 lakhs plus 58 lakh 50,000 comes to 1 crore 8 lakh 50,000. We can save 36 lakhs, right, sir? 1 crore 18 lakhs. Please add it properly. 60 lakhs plus 58 lakh 50,000 comes to 1 crore 18 lakh 50,000 is going to be our cost. And this is going to be our saving. So net cost is going to be 82 lakh 50,000. So this much amount I have to spend. Net extra I have to spend. But out of 30 crore, sir, today I will get 65%, which comes to 19 crore 50 lakhs. Into 12 by 3, because I'm going to calculate for annual. So my dear lovable students, 82 lakh 50,000 divided by 82 lakh 50,000 divided by 19 crore 50 lakhs. 19 crore 50 lakhs comes to some percentage you are getting. That is for 3 months. Into what by what? 12 by 3. Into 12 divided by 3 comes to 16.92% is the annual percentage. That's what 16.92%. I hope that you are able to appreciate or understand. The last question is from the maximum permissible bank finance. What will be the maximum permissible bank finance? Sir, they have given the terms. They said that, sir, entity is 75% of the net current asset. That means, what is the formula? Take the current asset minus current liability, you will get the net working capital. From that net working capital, sir, 75% of the net current asset. Net current asset. Are you all with me? So I have to calculate, man. Come on, man. Maximum permissible bank finance is 75% of the 7 crore 25 lakh 41,667. What is that 7 crore 25 lakh 41,667? Net working capital, which is nothing but current asset minus current liability into 75%. That means maximum the bank will give 5 crore 44 lakh 6,250. Basically the question answer is there in the question itself. 5 crore 44 lakh 6,250. If that is the case, 18.33 should be the percentage. So annualized cost of bank loan, sir, what is the percentage they are saying? They will be charging an interest rate of 16.5 and they will be holding how much, man? 10%. That means I'll be able to enjoy only 90%. So KD is equal to 16.5 divided by 90 into 100 comes to 18.33% is the KD. That's what the cost of debt. That can be called it as KD or they can be called it as any other thing. A very good question according to me from the working capital management. If you really studied working capital management, my dear lovable students, this will really give you a good refresh of the revision of the chapter working capital management. Sir, in the coming slot, we will be start solving the next case scenario, man. Case scenario number 8. With this 7 case scenario discussion has been comes to an end.